Good morning. Good morning. Welcome. My name is Megan Crane. I'm an Associate Director of Assurance at Dean Dorton. I've been here about 15 years. You'll be seeing me quite a bit today. I am the leader of our higher ed team. So we're thrilled to have several people in the room and a whole lot more people virtual. Today is our 9th year for the higher education, current issues and trends. It's a day we focus on finance, student financial aid, business officers, and we try to cover all topics, not just accounting. In fact, you might be thrilled to know there's not a FASB or a GASB session this year. So we're turning it on its head. We do have some exciting guest speakers today. Lots of resident Dean Dorton experts to spend time with you and some clients on a panel. So that should be an exciting day. So Dean Dorton has changed a little bit since we got together last year. We are one of the largest business advisory firms in the Southeast. We're now a top 100 firm. We have 560 total employees. So some of you virtually or in the room have been with us since we were 50 to 60 employees. So we've come a long way since then. So on January 1st, we've merged with Von Lehman out of Northern Kentucky, Fort Wright, Cincinnati area, and Indianapolis. So now we have offices Fort Wright, Cincinnati, Indianapolis, Louisville, Lexington, and Raleigh. So we're covering all the Southeast and of course cover clients across the United States. I have a passion for higher education, so that means that the firm gets to come along with us and also have a passion for it. Our higher education team, if you meet any of us, there's a couple here today, but we do cover all of our service groups. So your traditional services, audit, tax, outsourced accounting, IT, including anything from software sales all the way up to your outsourced CIO, cybersecurity response, etc. We're always open to conversations or questions at any time, not just related to today, but anytime you have questions, feel free to reach out to us and we'll get you there. All right, now down to the business. If you're on site, here's your Wi-Fi password. Hopefully you've gotten that in. Here's our agenda today. We'll start off with me. Hello, good morning. We have a keynote and then you get me again. So what a blessing, have me twice in a morning, really. And then we'll go into data analytics, cybersecurity, risk assessment, and then wrap the day up with unrelated business income analysis. All right, we do have polling in some of our sessions. You need to participate regardless of if you're in person or virtual in order to receive CPE credit. Each question has about 60 seconds to respond. Let's do a test question to make sure everybody's ready. So you can either text or go to the internet, but if you text, you're going to put 22333 in the 2. So that's who you are texting to. So that's where you put mom, dad, kid, sister, whoever. And then the message should be Dean Dorton. And that should get you registered to log in. And then you can just continue on that text thread. You can also use the internet and website if you prefer that. Let's try one. Okay, everybody's jumped ahead. Good job. What is your favorite color? Red, blue, yellow, green, other. Oh, good. It's working. It's moving. My dress is covering almost all of these colors today. All right. Good job, everybody. Blue. I like blue too. All right. If you are in person. Oh, one more thing. Yes, if you are in person, restrooms are outside this door and down the hall. We'll have lunch on the 2nd floor, so we'll take the elevator up like you did for breakfast. If you have technical issues, virtual friends, you will reach out to Julia Ray. Her email address is jray@deandorton.com. She can help you with any and all things. If you're virtual and asking questions, please use the Q&A box in Zoom. I bet I have a slide about this. Oh, there you go. All right. Oh, there's the Q&A box. If you want your presentation materials, they can be found under the agenda, and then there's all different items in there, all different PDFs. If you didn't receive them, you should have received them on Monday from Julia, but this is another way to download them. Additionally, in the marketing slicks, there are all sorts of other slicks about our firm. So if you have an interest in other area or other service line, you can check those out as well. All right, the most important part of the day, CPE credit. That's why everyone's here to see me. But outside of that, I know everybody wants CPE. In order to receive your 6 hours, you would need to be active, attend the entirety of each session. If you're virtual, please keep your presentation up on the main active window. Clicking out of the main window could result in loss of CPE credit. And then for those on Zoom, please update to include your first name, last name, and organization. So don't be Blue Cat 123 because we don't know where you work or who you are at that point and cannot provide credit. See, Julia Ray is on there as an example. So you can look at her name if you need an example. CPE certificates will go out in 2 weeks. All right. For coming today, you do have an opportunity to win a Yeti Hopper portable cooler. It'll be drawn at the 2 p.m. drawing or 2 p.m. break. If you are in person or virtual, we will talk to you about how to get it to you. So you don't have to come pick it up from our office. We'll mail it to you, probably via that fancy company, Amazon. All right. If you need any other help, please ask Julia Ray, or I can answer it as well. Any questions to get going? Everybody excited? Good, good, good. All right. Well, I would like to kick us off by introducing Donna Barrett. Donna is a director of institutional finance with SAC-COC, so the Commission on Colleges for the Southern Region, or formerly regional accreditor. Donna and I have met, well, I attended her session many moons ago as a small young person trying to understand higher education. But then her and I got to work together on the SAC-COC board the last 3 years as I was the representative from Kentucky. Donna has a BS in business. She's an honors with honors from Auburn. She has her MBA from Barry. She's worked as a state financial examiner, large private institution, medium-sized public institution, and then she's been spent nearly a decade as a business officer at my small private college. So she's basically done it all. So she's worked in all sorts of institutions. Her job at SAC-COC is the financial czar, I'll call her. If it's a financial case, Donna sees it, which is refreshing as a finance person. I love to see that someone else is really looking at it, and Donna has all the expertise. She's part of NACUBO. Her sessions always receive rave reviews, are totally packed at any SACS meeting, any of those other sessions. She does live on a farm with her husband. That's been her husband's family for 6 generations in the foothills of the Northeast Georgia mountains, which I always love a good personal touch. So Donna's going to spend the next hour with us talking all about accreditation. I know it's a subject near and dear to everyone's hearts. And so hopefully you get some good information there, and we appreciate Donna coming to be with us this morning. It's all you. That sounds like you're on. Yeah, great.
Can y'all hear me? Can they hear me? Hallelujah. All right. Thank you for having me. I appreciate Dean Dorton. You are an interesting bunch to me. You out there, wherever you are. We've got public institutions, we've got private institutions, we've got a for-profit or two out there. Some of you are SAC-COC members, some of you are not, and then we have all these lovely accounting people that I actually get to be in the room with today. A note about the accounting folks. It's not unusual for institutions to ask me, what auditor should I hire? Who can I use? Who would you recommend? And in the position that I'm in, I can't recommend one, but I can recommend 5. And Dean Dorton's on the list. So just know that there are very few, I won't say that, it's not fair. There are a few that are doing an exemplary job in higher ed. And Dean Dorton would be one of those. And I'm proud to recommend y'all when I can. The 5-minute rule applies. Before I came on with the commission, I've been here since 2003. So I've been here a long time. I was the CFO, small private institution, nearly a decade. I sat through so many training sessions, and y'all sit through training sessions. And I hated it because I had things to do. And so I told myself, it's the 5-minute rule. 5 minutes of every hour of things I have to sit and listen to actually apply to me. But the doggone thing is the 5 minutes is embedded somewhere. So you have to listen to the whole hour. So tell yourself, if you get 5 minutes worth of really good information today in the next hour, this is a win, right? There is nothing that we're going to talk about today, if you're at an institution, that will hurt you. We're going to talk about best practices, things evaluators are looking for, how this thing works. And you may say, FASB doesn't require that. You as an auditor may say, FASB doesn't require that. Donna Barrett doesn't know what she's talking about. What I'm telling you are things you can do that make it all better, that may not be required, but that will make life better for everyone financially. And it will help you in the SAC-COC process. I have to recognize Megan Crane. Megan Crane was on our board for 3 years. Jesse, here are the people that are in this session out there virtually that work with us, that do work with us. Jesse Wilkes, or that are in our evaluator database. That's important because you may have signed up to be an evaluator. I may call your name out and you may never have been on a visit, and that may be aggravating to you. If you send me an email, I can mark you as motivated, someone who wants to go out. And so just bear that in mind if I call your name and you haven't been out, let me know. Jesse Wilkes at Alice Lloyd College is in our database. Karen Blevins at Ashland Community and Technical College. Dale Cecil at Brescia. Mark McLean at Fletcher Technical College and Community College. By the way, Mark, you got rave reviews from Matthew Melton. He said you were great. Rosemary Allen at Georgetown College has been on over a dozen committees. So we've got a great experience base here. David Wilhite at Georgetown, Carolyn Kasdorf at Grayson, Barbara Campbell at Maysville, Dawn Osborne at Methodist University has been on 2 committees, Leah Rice at Midway here in Kentucky. Your president is on our board and he loves you. You just need to know it, whether he says it on a daily basis or not. Mary Pfister at Morehead State, Jackie Dudley at Murray State, Kathy Worster is out there. She should be here instead of me teaching this. Robin Leslie at Pfeiffer, Bethany Dupree at Sullivan, Angela Martin at the University of Kentucky is a board member, executive council member, chair of her state delegation, and has been on about a dozen committees. And one last wild card, Amy Scalf is out there. Well, Amy, my maiden name is Scalf, and I have a cousin named Amy. So Amy, if that's you, it's nice to see you. If not, then we're probably related somehow. My father and mother are both from Kentucky. So here we are. I want to give you 2 things that are not in this presentation, particularly if you're at an institution. My email, so you can send me a message. It's just dbarrett@saccoc.org. dbarrett@saccoc.org. If you send an email and the message line says Dean Dorton Conference, I'll answer it. But if you send an email and the subject matter line says accounting question 13-1, then I'm going to go through your assigned SACCOC vice president, who will then go through your accreditation liaison, who will then, you'll have to ask people permission to answer the question. But if you ask a question and you say Dean Dorton, then I'm going to think it's a question about this session, and I'll probably go ahead and answer you. We don't want to step on toes with the chain of command around here. All right. Onward. I am on the staff of SACCOC, and we're going to talk about what that even is and why you care. I will never be on a committee that visits an institution. I get no vote on the SACCOC board. Megan did. Angela Martin out there does. Every institution is different. It's general information in common situations, and there are many types of institutions in this session. So we're going to make a deal. The deal is I tell you the truth and you don't get mad at me. Fair? Sometimes after I give a presentation, I will have people from institutions that send me an email and they say, I'm really mad at you. You aired our dirty laundry. How dare you talk about my institution in such a way? We are no longer friends, that kind of thing. But that tells me they're a little sensitive, right? Because everything we're going to talk about today is a common situation. I'm not picking on anybody, I promise. So the deal is I'll tell you the truth. And the second part is you don't get mad at me. So what is SACCOC? These are the things we're going to talk about. What is accreditation? Why do we care? What do you want? When do you want it? As accounting and auditing professionals, when do you want it becomes a pertinent question for you. It's hard to get an audit quickly when you didn't know you needed it, right? All right, so what are we? We are the Southern Association of Colleges and Schools Commission on Colleges. We were established in 1895, and that's kind of important because if you think about the timing, Civil War's over. Country's beginning to grow again, and education is booming. Many of our current colleges were started in this period of time. Two problems in the industry. There were charlatans in the industry, and nobody wanted to take anybody else's credit. So transfer of credit was a big problem. And so schools got together. It happened regionally. We are the Southern Association of Colleges and Schools. Happened regionally. Colleges got together and said, we're going to make a rule book. We still have it. It's standards they agree to meet. We're going to make a rule book, and we're going to check each other, right? Because nobody knows us like we know us. And you have to join our association. We're still an association. Accreditors are associations of members. We'll check each other. And then some smart person out there said, well, what if the people that visit are idiots? Or what if the people that visit hate me? This isn't fair. This isn't good. Boards were established to review all decisions. And that's what we have today. All the committee visits come up, all the reports come up to a board that levels everything. Our board has representatives from every state in our region. Megan was on our board. We have public members and institutional members, and we have one public member from every state. Somebody who's outside of higher ed that's supposed to kind of act as an independent watchdog sort of person for the public. So it's just interesting historically how we came to be. We weren't tied at the hip with the federal government as a gatekeeper for Title IV aid until somewhere in the 60s. So we did just fine before that, right? That's what gets a lot of the focus. But this is a quality assurance machine with standards set by the members. We're a private organization. We're nonprofit. We're voluntary. We run about 800 members, and the members set the standards. A few years back, the federal government said there are no more regional accreditors. There are institutional accreditors, and the difference being we accredit the entire institution, all of its programs and all of its activities. Some accreditors will accredit medical programs or some other type of professional program, but we accredit the entire institution. And we have standards in lots of areas. Most accreditors do. They'll have standards in administration, faculty, whatever. Today, we're going to talk about finances. So what is SAC-COC? People get good and bad. They often get good and mad at me when they're in financial trouble, but SAC-COC is our member institutions. Every president serves as a delegate to our assembly, and they get to vote on the rules. So nobody on staff, myself included, makes any rules or sets any policy. It comes from the members. So if you're a college and university, SAC-COC is you. You can see here where we are. Typically, now we do have international members and we've got some far-flung members, but generally we run from Texas to Virginia. Why do you care? I'm going to give you the stated reasons why you care, and then I'm going to give you some other reasons you might care. We improve quality. We assure the public that institutions are going to be around for a while, and we serve as a gatekeeper for Title IV. What I'm going to tell you is that the risks of noncompliance are much larger than these reasons. If you become noncompliant and it becomes a public matter, and our board decisions are public matters, donors may not want to give you money anymore. Students with savvy parents may not want to send them to your institution. It could hurt enrollment. Faculty who say, I'm not staying around here if we're going to be in trouble all the time. This is hurting my reputation. And faculty will leave, good ones that have a lily pad to jump to. So it's funny to me that when institutions get in trouble, the first thing they say is, I don't want to lose Title IV. And then somewhere a year or two in, they say, I'm losing faculty, I'm losing students, I'm losing donors. This is, you people are killing me. It's like, ooh, whatever. But you personally might care. If you have a student that's going to be attending college, for heaven's sake, look up and see who their accreditor is and go see if there's anything out there about them. It's fascinating reading, I think, but you may not. But it's a well-informed consumer who knows what's going on at the institution where their student's going to go. You might be a student yourself. You might be thinking of becoming employed by an institution. And it would be nice to know what you're about to step in. I meet a lot of presidents when their institutions get into financial trouble, and they're usually good and mad at me when I didn't do it, but whatever. What I would say to you is that if you are a parent, a student, employment, or a donor, there's a wealth of publicly available information. You can go to the accreditors' websites. You can go to guidestar.org and pull their tax returns. And their tax, if they're a nonprofit or a foundation, their tax returns will have balance sheets and revenue and expense. And let's say you are thinking of going somewhere to be employed, it'll have top 5 salaries. Wouldn't that be an interesting thing to know? There is information out there, but often when I meet presidents who are good and mad at me, they say, I had no idea. And it's like, well, that's on you. At the very least, you should ask for a couple audits and then be nice to an accounting person and ask him to look at them with you. So you do care about accreditation. It hurts lots of things when there's trouble, and it assures the public of quality. So to do now, you can go to our website, look up yours or anybody else's institution. If you are at an institution, you have people. Your state will have members on our board of trustees. And so you can go to our website, click on your state, and see who your people are. And if you have a question, comment, complaint, whatever, you've got people that you can talk with in your state about this. You can see what the status of your institution is or any other. And you can see who's assigned to your institution on our staff. It won't be me. Every institution has an assigned vice president, and that is not me. I have them all when they have financial trouble, but I'm not assigned to anyone in particular. So what do you want from us? Every 10 years, we make things so much harder than they have to be, right? Every 10 years, you answer the questions in the book. There aren't that many. They're plainly stated. It's an essay test. That's all we're talking about here. Every 10 years, you have to answer all the questions. Every 5 years, you answer a portion of them. We got in trouble with the feds because they said 10 years was too far apart to do a comprehensive review of institutions. So now we do a 5th year review that's somewhat smaller. So those are standard, and we're going to talk about when they are. And if you're at an institution or you audit an institution, then you probably want to know when those dates are, right? I mean, when is stuff due? What do you want from me? How many audits do you need? As a former CFO, I was like, what do you want? Leave me alone. So those are easy. Those are definable. We can talk about those. But there are some other things that can create the need for reports to SAC COC by institutions, which might create the need for audits in a timely manner. Less timely than 9 months. I mean, more timely than 9 months. Quickly, audits quickly. If they're adding off-campus instructional sites, there was a new federal mandate. We're about to get through them that required audits. Substantive change. Sometimes institutions get in trouble and they say, we're going to grow our way out of this. And so if they're a 2-year school, they're going to add 4-year programs. Or if they're a baccalaureate, they're going to add masters. And you get the idea. We call that a substantive change. If you go from 2 to 4 years, that's substantive. If you add a doctoral program, that's substantive. When that substantive change application comes in, it requires audits. Good morning. And so look, the reason that's relevant is you're floating along and you're having financial trouble, but you're between the 5 and 10 years and nobody's asked for anything yet. And you send in a level change application and it has audits and you're in trouble, right? What could happen in a terribly depressing world is that your substantive change could be denied, and then you could go on monitoring and we want reports on the finances. So in trying to do a good, unintended consequences, right? In trying to do a good thing, you've done a bad thing in that now you're on the radar screen and time is ticking because you only get so much time. So just know if you're out there in an institution and you're going to grow your way out of this situation, if you send in a substantive change prospectus and you send in audits, someone will read them. Sometimes people are surprised. You looked at that? If you hit the news, headlines, media, XYZ institution lays off 10 people. Or it could be spicier than that. XYZ institution, president and secretary in Bahamas with $10 million. I mean, the stuff that happens, you really can't make up. But if you hit the headlines, it's entirely possible, particularly if there's a financial slant to it, that you're going to get a letter that says, please send us a couple audits. What's going on at your institution? Complaints. Every institution, hands down, has 2 faculty and 5 students that complain regularly. Okay, we get, there are people for whom I receive an email at least weekly. Did you know what they're doing over there? That's not what we're talking about, because everybody's got a crazy or two. All right. And we know that. But when we get 50 complaints about the same thing from different people, there's a problem. Maybe when we get 5 from different people, there's a problem. But if complaints begin coming in, I can't get my refund check. I didn't get paid last month, and I'm a faculty member. I found out my taxes hadn't been paid to the federal government in 3 years. Believe it or not, these things happen. Complaints can get you on the radar screen, and it gets a little sticky. And if you're in trouble with the Department of Education, that can get you on our radar screen too. The thing about Department of Education issues, our standards are different, and we don't hold institutions accountable. That's not a good way to say it. Our standards are different. For example, Department of Education usually runs a year or 2 behind in the letters they send. You know, we don't like this, we don't like that, whatever's. And so we usually ask for more recent information, and we move on to our own standards off of theirs. We don't hold people to that, but they are a good red flag or a bad red flag. Okay. If you're at an institution, consider building a relationship with your institution's accreditation liaison, your president, and your financial aid director. Why? It was a frustration to me as a finance officer that I never got the letters, right? From the accreditors. I never got the letters. I got some faculty member in my office the week before. I need an audit because I got to send it with this stuff. And I'm like, what are you sending? What did they ask for? Oh, I don't know. They just want some audits or something. Really? There's not a report that goes with that? But see, I never got the letters. So I was always on the back end catching up. And then I have to call my auditor. I'm going to need an audit quickly. Well, I wish you told me 6 months ago, because we scheduled these people 6 months ago. So if you make friends, or at least professional acquaintances, buy them a Coke, buy them a beer, take them to dinner, take them to lunch, whatever you have to do, you need to know what these people are getting in the mail. Because if they get a letter from us, it might ask for something financial, and they may gloss over it because they don't even understand the words, right? They all get notifications you may need to see. Consider building a relationship with your auditor. Share due dates for your SAC-CSC audits. What's due, what's when, and here's the thing. Institutions would do better to identify bottlenecks in their process, and it might mean asking a hard question or 2. Who holds you up on our campus? What wasn't reconciled last time? You know, what office didn't give you what you needed? For me, it was always advancement. They made me insane. Identify the problems in the process. The other thing, you know, it's probably a good thing in 2003 that I left an institution and came to work for the commission. Because I had gotten a little rampant, you know? And so my auditors would come, and I loved them, they were friends. And I would put them in a room, and this is no exaggeration. I gave them a refrigerator, a microwave. I sent them all the form and said, what do you drink? What do you eat? What do you need? Tell me now. And I filled the refrigerator and the microwave with everything they needed to eat or drink. I gave them a copier. I gave them a phone list of every single person that they needed to contact for every department. I gave them a fax machine then, which no one uses now, but anything I could think of. They got their own copier. Nobody got their own copier at the campus. By golly, the auditors did. If I could have put a bathroom in the room, I would have done so. Because the most expensive thing to me I've ever seen is a confused first-year auditor walking down the hall with a paper in their hand. I mean, that's money to me. That's time wasted on everybody's part. And so, and then I gave them all the names of the people. And then I told my people, if they call you, run. Run. We need this done. This, you know, I gave them access to my general ledger. I put giant calendars on the wall in my office where the public couldn't see, but they're on the sidewalk. I crossed off all the weeks and said, no vacation here. Don't even ask. And I did that a year ahead of time, working with the auditor. When are you going to be here? What do you need? So that everybody knew this was a quest we were going to finish, right? And so we scheduled the work. We identified the bottlenecks. I asked them what they needed, and I told them what I needed. And we got audits fast when we needed them. So consider building a relationship. Ask them what they like to eat. I don't know. When do you want it? Every institution has a timeline for their reaffirmation. You have been given as a handout a cryptic thing that looks like a list of dates and names of institutions. Okay. I can't see if it looks like that. On the left, you'll have institutions alphabetically, and it has a track and a year. Institutions that are A's don't have graduate programs. Institutions that are B's have graduate programs. The year is the year you'll be reaffirmed. It's the year the big report is finally reviewed by our board. So for example, Alice Lloyd is a 2028A. That's what we would call her track for this purposes. The reason for the columns on the right are so that you can see who else is in your group. Misery loves company. Someone from all these institutions is attending today, and someone from all these institutions would be a nice contact for you if they're in your reaffirmation class, just so you can say, you know, how are y'all doing on this? What, you know, whatever. It would be nice to have a buddy in the process. Compliance certification typically requires 2 years worth of audits, including the most recent. The 5th year requires, at a minimum, audits of federal and state aid. Now, this is the most hateful slide in the history of man, but I'm going to tell you why I hate a busy slide, and this is like the worst. But, and just for what it's worth, if you're at an institution and you see this, and now you've gone to the bathroom because who wants to even know about this? This is a master schedule. This is how I look at things. We get staff. I'm the only finance person in a building full of former academics and presidents. And they talk lofty things. And I'm like, tell me when it's due. That's what I want to know. You know, stop. So this is how I look at this. And so if you are an institution, this master list is on my website. Here's my website. It's just our organizational website, saccoc.org. You go to the staff directory and find me, Donna Barrett. My homepage has this listing. And the thing about this listing is that occasionally dates change. And I do try to update it and keep it current. So the one on my website is going to be golden for you most of the time. All right, so why is this relevant? Well, it's relevant if you are, we're going to talk about people today. If you are Midway, Sullivan, Western Kentucky University, you are 2025 Bs. So what? Okay. Well, on the master list, which I will not subject any of you to looking at, but if you're a 2025 B, your compliance certification, the big giant essay test on all the standards, is due in September of 24. Why do you at Dean Dorton care? If you audit Midway, Sullivan, or Western Kentucky, they're going to have an audit due with that compliance certification. Now get this, September of 24, it's going to be probably the June 30, 2024 audit. Is anybody getting Western Kentucky an audit in 3 months? Probably not. Privates might get one. But I will tell you, that's the date the compliance certification is due, and that's an important date. Because as of that date, September, I think it's the 8th, 24, that defines the audit that will be required to get through this process. Most institutions don't have their audits that quickly. Some do because they've done all the things we talked about on the previous slide. But there is a grace period to October 15th to get just the audit in. You can send everything else on time in September, but the audit can have a little more time if you ask for it. So institutions need to know, you got to say, this isn't going to work to your vice president. And then your vice president will say, oh, I'm marking you as a late submission. Excellent. And for you as an auditor, it would give you a little bit longer to get that audit done. For those three 2025B institutions, the offsite, it's a committee that meets virtually. It's a paper review. They get all the compliance certifications, which are just the answers to the questions. That's all it is. We make it so much more complicated. They get all that, they read it, and they say, these 10 things we still need more information on, and everything else they wipe. Pretty good deal when you can get it. And that happens in November of 2024. Then an on-site committee is going to visit. So the school sends a report, an offsite reviews it. The school responds to whatever's left from the offsite, and then a committee comes to the campus to look at it and visits the campus. And that is in the spring of 2025. Then the institution responds to that. So this is their third submission, right? It's their third chance to get it right in the fall of 25. And so technically, to be reaffirmed, they would have had till the fall of 25 to have that June 30, 2024 audit in. It's a process. It's a back and forth. It's like a ping pong match. You give me something, I send it back. You give me something, I send it back. But for those three institutions I mentioned, Midway, Sullivan, and Western Kentucky, in December of 2025, they will be reaffirmed. Why do you care? Well, first of all, it's a review. And so there's going to be public information put on the website about what was out of compliance and that sort of thing. But it all becomes public then. Prior to that, all these reports, you're terrible, we're wonderful, you're terrible, we're wonderful, you're terrible, we're wonderful. They're not that dramatic, but it feels that way. Are confidential. The readers are confidential. None of it gets put in the paper because it's all confidential. But when the reaffirmation comes and they've had 3 shots to fix stuff, the standards that are non-compliant become public. And that's when it matters to students, donors, faculty. And it's embarrassing. I mean, you know, when things pile up, it's embarrassing. And it means more reports. And if you're at an institution that you just want to be done, the last thing you want is another report. So if you are here and you are Asbury, Brescia, Kentucky State, Methodist University, Northern Kentucky University, or the University of Mississippi, you are a 2029 B, right? And so you're out here laughing at the people we just talked about because you think, I don't have to do anything till December 26th, and this is far away, and I'll be retired by then, and everything's good. Not so fast. If you're one of those schools I just called out, you will have a 5th-year report due in 2025. And here is why you care. Because remember when we talked about finance officers don't get the letters. You don't know what people want. You don't know what the commission wants. Well, in April of 2024, if you're at Asbury, Brescia, Kentucky State Methodist, Northern Kentucky, or University of Mississippi, your president and or your accreditation liaison got a letter. And that letter asks for your 5th-year report. You need to see the letter. So you need to, I mean, and this was like last month, okay? So you need to see the letter because the letter may ask for financial information. The report is not due until March of next year. It would be way better if you knew you had to get an audit in now than March of next year. It'd be better for your auditor to know. If I audited any institutions, it'd be a fun little exercise. You could go to our website, list out all your institutions that you audit. You can look up on our website, their year and track. You know, what year they're gonna be reaffirmed, and do they have graduate programs? You could write down all their little years, might take you an hour. Then you could go to my website and get the handy dandy master list, because that's how I have to look at things. And you could see who had stuff coming up that was due. And then you could have a conversation with them. You know, the last time we were there, you hadn't reconciled your bank statements in a year. Your general ledger was out of balance. You know, you didn't even have, you know, a controller. You're going to be on a tight time frame. Let's talk about how we can manage this. It's in your best interest as accounting people to understand what's going on in the institutions and what's going to be asked of them and from them. I don't know if any of that makes any sense, but just know at reaffirmation, that final day when the case goes to the board, the monitoring clock starts ticking. You only get 2 years by federal regulation on monitoring. At the end of those 2 years, the institution can either have to be dropped from membership or put on probation for good cause or found compliant. At the end of the 2 years, something bad is possible. You can be dropped or put on probation for good cause, but you've only got 2 years. Well, it's really, really hard to fix a financial problem fast. It's even harder to prove you fixed it, because you've got to wait till the end of the year when you get the audit and prove it, because we consider audits the gold standard. Every report that we receive, not everyone, but most, say everything's fine, we are compliant, go away. They don't say it like that. They say it in a much more professional manner, but I'm telling you, that's the gist. We got this, go away. But until we have the audit to prove it, the institution is non-compliant. So just know the time starts ticking and they only get 2 years. At reaffirmation, the decisions are public. And what's worse, we have a variety of financial standards, and we're going to talk about a few of them. But if we have standards that are core requirements. We consider a core requirement fundamental to being an institution. It's fundamental to being a college or university. They're big, bad standards. Then we have a lot of other standards that are not core requirements. If you're not compliant with the core requirement, you have to go on sanction, which is warning or probation. Again, this is not pleasant and it makes people aggravated. And non-compliance requires additional reports. So my question to institutions is, when would you like your emergency? And can it be avoided? When an institution receives an offsite report, that's way back at the start of this 1.5 year, 2 year process. When they get an offsite report that says you are non-compliant for finance, if it's me, that's when my dumpster fire occurs. I'm gonna find out, what did we do? What's wrong? What was the problem? Because then you might still have a little bit of time to fix it, right? But what sometimes happens, and I understand, is that CFOs will say, good grief, the committee was full of idiots. They don't understand us. They didn't even try. And then they write a hostile report that says, you people are morons. Leave us alone, go away, we're compliant. I would urge you, if you're at an institution or if you're auditing an institution and they receive an offsite report that shows non-compliance, give us a call. And you'll get me, and I'm sorry for that, but we can go back and look and see what the committee saw. Maybe they missed some materials, maybe some materials that you uploaded didn't upload. Maybe, I mean, there's no way to know. There are myriad possibilities of what happened. But there's also the possibility that you're really having some financial difficulties, which have been identified. So try to have an open spirit to it and figure out when you'd like your emergency. Because if it's me, I'm having mine early. Because when it all becomes public and there's a financial problem, this is not good for anyone. So the other thing about that, if an institution is reaffirmed and they have monitoring, it's going to mean more fast audits. because you're gonna have report after report after report due. And so you as auditors need to know, if it were me and I were you and I had a list of clients, I think I'd go see if there's anything public about them on our website. And I think I'd go look and see if they have monitoring reports too, because I think that's on there too. Let's say you have a new client that has come to you that says, we've had a little bit of a sticky wicket with Saks COC, but we think we're good now. Go look and see what you can find. I mean, it might be worth knowing before you took a client. Maybe, maybe not. Maybe it doesn't matter to you, but you'd go into it with more open eyes. All right. Current issues and things we're going to talk about briefly. We only ask for one number in our book, and we're going to talk about that, UNAEP. Operational outcomes, Title IV audit evidence, state audit evidence, physical resources, and some other financial standards-ish. The only number we ask for, and if you want it defined, it's in the book in 13.2. By the way, two things you might find interesting. This book is on our website. This is actually the most recent has just been printed. I don't have it in my case. But the most recent Principles of Accreditation is on our website, as is something called the Resource Manual. The Resource Manual has a page or two, or more or less, on every standard in here. So if you don't know what a standard wants, you can go to the resource, and we're section lucky 13, by the way. I consider that lucky because that's what we got. The Resource Manual will have 13.1. It'll have 2 or 3 pages on 13.1. 13.2, 2 or 3 pages. What does the standard mean? What do you want? And what are some approaches to establishing compliance? If everybody, I think they're daunted by the Resource Manual is kind of thick and this whole big book full of technical words. But if you just go to section 13 to read this, and you just go to section 13 and do that, you can do that in a morning. And it would give you a pretty good idea of what it is this organization wants from its members. Anyway, 13.2 is where you find a detail of UNAEP. Okay, we know you don't have to tell us that FASB changed your language if you're a private organization from unrestricted to without donor restriction. We know this, but the public still use unrestricted. And then the for-profits say, well, none of ours is restricted, so this doesn't apply to us. First, UNAEP applies to everyone. We know that unrestricted is without donor restriction. Privates, your audit may or may not provide this number. And we're going to talk about some ideas. It doesn't have to, but we're going to get into the nuance and the finesse and how you might make this whole thing easier. Publics, Lord have mercy. I don't know how many publics shall audit, but the pensions, the OPEB, we're going to talk about that. For-profits, all net assets are considered unrestricted. It's the only number our standards ask for. They ask for audits. This is the only number. So people are always saying, I need a benchmark, I need a benchmark. It's like, we don't have any benchmarks except this one. So privates, your statement of net position, your balance sheet might look like this top example. Without donor restriction, with donor restriction, 2 million total net assets. It might look like the second example, because I have to tell you, I read probably a couple hundred audits a year, all different auditors, all different kind of institutions. And you all follow the same guidelines, right? I mean, it's FASB, right? Your audits are all so vastly different. It's like, it's as if you're in different worlds. The interpretations and the formats and the way they're written, vastly different. One of the things I have a bad habit of is back to audit firms. Our regional audit firms that do other institutions of higher education do a little bit better job at the format, but we'll move on. Anyway, your balance sheet might look like any of these things. It might break it down by time or purpose or perpetuity. It might pull out your investment in land, buildings, or equipment. It might, sky's the limit on the way balance sheets look, as long as they show restricted versus unrestricted. I have a suggestion. You don't have to do this. Do not go back and say, Donna Barrett said we had to do this. We hate her. No, This is a suggestion. I'm going to tell you why I'm going to suggest it. What if you're private, publics and for-profits, please don't listen, but if you're a private, what if the face of your financial statements looked like this? Now, the Dean Dorton people are going to say, you know, we have a net asset footnote, right? I want you to pay attention the next time you present an audit, if you're a Dean Dorton person, to a board. Here's what they do. It's shiny and pretty. And you put it, there's one in every spot. And you come in and you say, well, it was a pretty good year. I'd like to hit some highlights. And the board members who maybe pastors, faculty, there might be a few finance people, but they probably own a hot dog shop or building firm, or they're a lawyer, or they whatever. But they've got the shiny audit and they open it up and you're talking, and they open it up and you're talking, and they might get as far as the balance sheet. They might even make it to your activity statement, but then they close the audit and they listen to you. And whatever you say to them, they believe, because you're the auditor, right? Nobody made it to your net asset footnote. And I'll tell you a secret, they're not going to. Because if you think the statements are bad, you wait till you are a layperson and you get to the footnotes. Nobody's reading it. So what I would say to you is that to consider showing on the face of your balance sheet, we want unrestricted net assets, less plant, add back plant, your equity in plant. We want the plant pulled out of your unrestricted net assets. And in this case, when you do that, you pull out the investment property or plant, they're in a deficit for you and AEP. This is the same institution with a different format on their balance sheet. It also shows, and so there are lots of things that are interesting about that. All of a sudden, if you're a CFO and you can show somebody this audit, you can say, yeah, I know it looks like we have a lot of money, but operations is tight. No, you can't have 3 new Russian faculty members. You know, as a CFO, this gives you information you can share in a very reasonable manner. Those SAC-COC people said we have to identify this number. And so, no, you can't build a new building right now, or you can't do whatever it is you want because things are tight. I will, however, continue to pay you if you go away and leave my office. See, it was good that I left an institution. Anyway, I'm just saying to you that if all of a sudden everybody understands, here's another way this is kind of interesting. If you break out the time and purpose for perpetuity, you might have an institution that is running a capital campaign. That money has to be spent on buildings. Well, if you don't break it out in some way, all of a sudden the restricted money looks huge. They think it's endowment. They think, oh, we're rolling in the dough. But this might be an interesting way to say, now see, our temporarily restricted or time and purpose restricted items went up, but that's because you're in a capital campaign right now, and we're going to use that for the building. You know, it just puts everybody on an equal footing, and it gets them to a page they'll actually probably read. This is what I hear from CFOs. If we identify that in the audit, I'm going to look terrible. We're going to look horrible. It's going to look like we don't have any money. We're going to be great. That's wonderful. Not a single CFO that I know of was at their institution where they're working now when it was founded. And I hope to goodness not a single CFO that I know is going to be at their institution when it's closed. So you are a steward, and for me, it's an ethical and moral responsibility to throw it out there. And if you look bad, then maybe they'll stop asking you for new employees. The goal is clarity for everyone. You spend as much on your audit, probably, as you might on a shiny new car, right? Don't leave it in the garage. Let your audit speak management information, board information in a clear way. So So everybody understands it. Things you ought to know if you're private and you're doing the UNAP number, there are some things that evaluators will consider. They'll calculate the number and they'll back these things off. They'll say they got debt reserves because those are technically not restricted, but they are held and you can't spend it. Horses will die every time. If you are balancing your budget with horses, God bless you. Please don't tell me. If you're revaluing artwork, right? Balance your budget. That's a problem. And evaluators will back out artwork. Investment land. There's this interesting thing people are doing, and I understand it, but they are chopping off their campus and saying this piece is investment because we're in downtown city, whatever. It's worth $1 billion. But nobody knows it because our plant was bought in 1895 for $2 from a farmer. And so they want to revalue some of that plant to make the balance sheet look fuller, shall we say. Well, if you've done that, the bank's probably happy, right? Because you got more collateral, but unless it's being actively marketed, actively sold, there's a contract, you're going to do something with that, then investment land is a suspicious item to evaluators. Uncollected receivables and intangible assets will very often, they'll say, it looks like they're okay, but they're not. So if you're private, get a cup of coffee, do whatever. But if you're from a public institution, a few years ago, Gatsby said, you've got to book pensions, healthcare for retirees, and you've got compensated absences, which they already had. And all the publics went bananas and said, we're going to get dropped from SACs. And if you look at this example, this unrestricted net asset position for this public is 36 million in the hole, 36.4 million in the hole. And that's because they have all these obligations that were pushed down to the institution, which are state obligations. And the thing to think about is that the state takes revenue in and pays the obligations out. The state doesn't, most states except Texas, nobody's from Texas, are they? Most states except Texas don't have a pot of gold or mineral rights sitting somewhere for this stuff. It's an in and out kind of situation. Well, they've posted the black hole to the public institutions. And so, again, a terrible slide. Take a picture of it if you need to, but these are all the adjustments, standard adjustments that our public finance evaluators are making. They're adding back all the obligations related to compensated absences, OPEB. The deferred inflows and outflows are enough to make me go nuts. Pensions, and so on. So just know that this institution, these were actual numbers, actually had a 3.1 and a 4.1 UNAEP because the evaluators adjusted the number. Does that make any sense? It's a mess out there. Now here's the thing for you as auditors. This is not in your format, right? This is nothing you're gonna, but what you can do is on your balance sheet, on your statement of financial position, you could break the deferred inflows and outflows into categories, because sometimes there are some deferred inflows and outflows related to debt. Those don't get adjusted. But if you lump all those deferred inflows and outflows together, then evaluators have to go dig for it. It's kind of a mess. So you could break out your deferred inflows and outflows by category. You don't have to, but it would be nice. And you could show the others, whether they're current or not. And you could help the institution that way, and you could help the evaluators that way. Three-legged stool. I know I only have 10 minutes, but this is important. There are only three things that institutions get in trouble for with us, really and generally. And that's, if I've never seen a school that ran positive operational outcomes, positive operational cash flows, and had a positive and improving UNAP remain in trouble with us. Never. If you're preparing an audit for a private institution, there are things you can do to help them that are not required but would be nice. If you can identify UNAP either in the footnotes or on the face of the statement of position, you get a bonus if it's a statement of position. If you could have one full year of comparative data, not just a column, it's going to take another page. I know that. Particularly good if you have an institution that's had restatements from prior years. Show the full activities for 2 years if you can. Break out accounts payable, trade versus planned. Some of our evaluators go, oh, they're not paying it's accounts payable, but they might be in a capital campaign and have outstanding. Break out debt, operational versus plan. And some of the other day said, well, we have to do that. And it's like, well, but it's not being done clearly in the way it's presented in the audit. Have a clear operating measure. That would be my number one beg of y'all, is to have a clear operating measure. Many of our institutions have revenues, expenses, change in net assets with no operational segregation whatsoever. And so 1 year is really good and 1 year is really bad. And they say, oh, well, that was investments that went up or down. Really, we're doing fine. But if you can get your audit to look like your budget, to look like your interim financial statements, everybody's on the same page. And I personally would beg you to do that, because if you don't, here's what happens. An evaluator is going to try to figure out, they're going to have your budget and go, oh, this doesn't look anything like the audit. And they're going to try to figure out how you're doing. And they're going to start backing things out and adding things in. And they may not do it right, but God bless them, they're trying. Give them an operating measure, please. Capital releases are non-operational. Depreciation is an operational expense. I was in an institution in the early 90s when this went into play and everybody disregarded it. I can tell you no one disregards it now. The thing about depreciation is that it is a larger conversation than how to put it on my revenues and expenses. What's the age of what are your estimated lives on your buildings? What are your salvage values? What is your, I don't know. There are a lot of other factors that relate to how depreciation actually hits an expense. And so I would urge you to look at your depreciation expense. If you say it's non-operational, it doesn't matter, and you have a your capitalization threshold, $500 capitalization threshold, and you say it doesn't matter. Interest expense is operational. Endowment spending per policy is operational, and the rest of the gains or losses are below. It's a magical thing. I just urge you to look at these three things and you'll never have trouble with us. We're going to run out of time. 13.6 federal and state responsibilities. We require an audit of federal and state financial aid. Many institutions leave off state. We do not want your program participation agreement. We do not want your USDE correspondence. We don't want your iPads. If we didn't ask for it, don't send it. Because if you send it, someone's going to find something that they have a question about. And for the federal and state financial aid, there is no requirement for most recent, so it can be a year old. So we already talked about substantive change. You have to prove your facilities appropriately serve your populations. It gets tricky. There are ideas in the resource manual. We have a standard that says guidance on debt. It does not mean Title IV. It's how are you telling students about debt? Easiest road is constant vigilance. When you have a financial problem, it's very difficult to fix it quickly. And many institutions are very hesitant to lay off people, and that's your biggest expense. So if you can have a clear balance sheet, have a clear income statement, maybe they won't hire the people you're going to have to lay off. Constant vigilance. If you're at an institution, please consider being a peer evaluator. It's the most rewarding professional experience you will ever have. I promise. Do it once. If you don't like it, let me know. I've never had anybody tell me they didn't. If you're an accountant working in higher education and you ever want to leave Dean Dorton, I'm not saying you should, and I hope you don't. I hope you all stay forever. But we are experiencing right now a real shortage of younger CFOs. I mean, it's dire. And so higher education is a lovely place to work. It's where I came from, and consider it. Questions? We're out of time, right?
2 minutes.
Questions? Well, you and I are a little bit in a weird situation, because if you call me and ask a question about an institution, I can't answer it unless it's publicly available information. Unless, of course, you call me and you say, I have this audit in front of me, I have the report in front of me, unless I know that you know what's going on, I can't talk with you about it. I have to talk to the institution. Another thing, if you have questions, a tactic for auditors is to have a conference call with me, the school, and the auditor. Because then I can talk freely to them and you can be there and we can all talk about what's going on. Thank you for your good work. Thank you for having me. Probably not what you expected first thing in the morning, but I really do appreciate the quality of job that this firm does.
Hopefully you enjoyed that session from Donna. She is a wealth of knowledge. So if you ever do have accreditation issues or concerns, I highly recommend trying to get in contact with her. All right, you've already met me. I'm Megan Crane. We are going to be spending some time talking about Department of Education updates. We will use polling in this session. So again, you practiced this morning. Hopefully it's still working, but you're putting 22333 into the mom, dad, sister line, and the message is Dean Dorton.
One word.
All one word. Dean Dorton. Say it fast. All together. No spaces, no capitalization, all the things. All right. For CPE, we have to talk about objectives. So here are our objectives today. We're going to talk about financial responsibility, administrative capability, certification procedures, and then financial value transparency and gainful employment. Hopefully it'll be a fun session. If you've looked at the slide deck, there's a lot of information in there. We are not going to talk about every slide. We'll move as quickly as we can, try to have some discussion if needed, and go from there. All right, so let's start with use one word to describe the state of higher education. So this is the polling question. So where you wrote Dean Dorton before, you can type in whatever you think your one word is. Sad. I knew something like that was going to come up pretty quickly. Uncertain, complex, stressful, unreliable. Okay, yes, evolving. Evolving. That's much more positive spin on it, I think. Tricky, unpredictable. Oh, unpredictability. Yes. We'll let it kind of settle. As soon as I think it's set, it's like higher education up here. As soon as I think it's settling, changes all again. But you can kind of see the words here: chaotic, expensive, confusing, uncertain, turbulent, stagnant. Well, we need more information on the stagnant one, I think. But yeah, there's a lot, right? There's a lot going on in higher education. I would argue that I'm going to include myself in higher education. The regulations are all coming down. We're being regulated almost as much as banks, maybe more than banks, probably the same as healthcare, maybe a little bit more because you guys are kind of those two industries wrapped into one plus education all together, right? So I'm not surprised that this is the response. Everybody's tired. This is not your time to take a nap. You might be tired, you can sleep later. Hopefully we'll have a fun session, but yeah, this is all happening. This is what you guys and me talk about every single day, right? So we're going to spend the next 50 minutes going over hot topics, which I think these hot topics are part of the cause of some of these words. Complex, unstable, again, changing constantly. So here's the areas. Oh, sorry. So here's what's going on. Here's what we're going to talk about, the FAFSA. I don't have enough advanced degrees in counseling or psychology to be able to talk through the FAFSA. We're moving on. Okay. There's not enough therapy hours or dollars left for the FAFSA. Okay. But that is a hot topic. That's what's going on. We're seeing, trends of 30 to 50% fewer applications in a pool of students that's already lower of graduating seniors. So how is enrollment being impacted? Again, that's a topic for another day. We are going to talk about the financial responsibility, administrative capability, and certification procedures that are effective July 1. Financial value transparency and gainful employment, which are also effective July 1. And then we'll talk very, very briefly about the Fair Labor Standards Act, also effective July 1. It's like the Department of Ed got with FASB and said, hey, they're done with leases and revenue. Let's do all these other things. So how did we get here? I'm so sorry. I told Julia, I was like, I don't need water. And then I'm choked. Okay, so how did we get here? So of course we know Higher education's been in the headlines, right? Every day you can open up the newspaper articles and say, okay, yep, there's something about higher education loans. There's something about the cost of higher education. Oh yeah, the school closed. Oh yeah, there's SAC sanctions or whoever. And from 2010 to 2020, there were 246,000 borrowers at 1,100 schools that closed. 43% of those did not complete their program, and over 80,000 had to have their loans forgiven for one reason or another. So you start talking numbers like that for a 10-year period, that doesn't even include that's pre-COVID, 2020, well, sort of pre-COVID. But so that's a lot going on. And now you fast forward 4 years later and it's just gotten bigger and better. So that's why we've landed here. So the department has said, hey, we need ability to act more swiftly. We need to keep schools out of risk behavior. We need to figure out, okay, if we're admitting a new school, let's make the standards a little harder. And then how are the students benefiting overall? So those that don't have a high school diploma, how are we getting them into higher education so that way they can benefit? All right, everybody buckle up. Ready? Here we go. Financial responsibility, administrative capability, and certification procedures. All right, polling question. On October 31st, because we were finishing audits in October, so this was super fun. They published a final regulation that, for institutions to participate in higher Title IV, how much do you know about this? So this was the financial responsibility rule. If you're a public institution, you're probably like, let's see. I hope there's no D's, no one is up. Good. You're going to be an expert by the end of this session. So this ruling came out in October. There were 4 main areas. Administrative capability, which is, it establishes rules for warning signs from colleges, to make it easier for the department to require letters of credit or other upfront protection. I thought an interesting fact here was that from 2013 to 2022, so a little bit different period than we talked about earlier, the department was seeking $1.6 billion of liabilities from institutions. So that means when an institution closed, there was 1.6 billion worth of liabilities out there. But they only collected 344 million during that time frame. So not quite the collection rate the department wants, right? Administrative capability is a way for the department to hold institutions more accountable, including clearer, more comparable information on financial aid. This is the transcript provisions. So we'll talk about that a little bit later. There's so many Easter eggs here. It's so exciting, isn't it? I'm like, wait for a little bit. Certification procedures talk about the conditions they can place when there are warning signs, such as teach out. So if you're required to do a teach out plan or agreement, if you've been limited on adding new programs, that's where the certification procedures come into place. And then the ability to benefit we talked about. All right, so the Higher Education Act established ratios. If you think back to 2019 for you private nonprofits, they revised the original regulations to have with and without donor restrictions and potentially apply to leases. Now they are revising them again, and we'll talk through that a little bit, but the 3 ratios are primary reserve, equity, and net income. There's a whole new schedule for you public institutions in the back of all the private financial statements. I've been actually working with a client this week because the department didn't like that we had negative numbers instead of positive numbers, because the negative numbers the numbers were positive on the face because it was assets, but in the schedule we were backing them out, math, like positive, minus, and that's how the ratio is calculated. The department didn't like it. So just know they are actually looking at and using these schedules. Who's impacted? All institutions. So if you are public, I know I've kind of said this doesn't apply to you, but there are some rules in here that do apply to you. So pay attention. All right. 2 main areas under financial responsibility. Related parties, and then this financial responsibility composite score, which includes mandatory and discretionary triggers. That's where the publics will probably come into play, and ratio trouble areas. So we'll talk about those. Related parties. I don't know if anybody has kids. My kids are like 6, 3, and a couple months. There's this movie Encanto, and one of the lines is like, "It was a nightmare." And that's how I feel about these related party disclosures. It was a nightmare. Okay, so if you are a private institution, you must submit a detailed description of your related entities and transactions based upon FASB ASC 850. So before we would say, They're either not material, so we would include as a line, or say you had none, and like last year, we would say that. Now you're required to have a more detailed description about those. So here's the definition of related parties under ASC 850. You'll see that a lot of areas fall in here. So think about trust, banking relationships, board members, et cetera, all fall under potential related party definition. So think about that. All right, so affiliates of the entity, any non-consolidated affiliated entities where there's receipt or provisions of goods and non-exchange items. For example, if you have a childcare facility on your campus and the faculty and staff don't have to pay for it, the institution pays the childcare facility, that childcare facility is a related party and you have to disclose those items because your faculty and staff are using it. Told you, it was a nightmare, right? You've got to think about management and others. So anybody that manages the entity and their immediate family. And then once you identify a related party, so once you've gone through all that rigmarole, we've talked to all of our board members, we've looked at everybody in executive leadership, et cetera, and we say, okay, once all of that happens, you need to disclose anything or entities that employ related parties, any entities that the related party owns or has an ownership interest in, or they have a governing role. It doesn't matter if they're an exchange transaction, a non-exchange transaction, or off balance sheet. So if you have a letter of credit with a bank and the daughter's father is on your board, that needs to be disclosed in this schedule. Again, for consolidated entities, management and trustees and their immediate families, you would think about anybody who has strategic planning and operating decisions. If you have a trust, so defined benefit plans, health insurance trust, et cetera. If you are only the administrator, it is not a related party. So keep that in mind. If you are a defined benefit plan and you are the admin or the trustee, you would still disclose the name, et cetera. Your normal retirement plan disclosure may not have enough information that you can just say, see, note, whatever with that information. It probably doesn't have enough information in it. We'll have to flush that out a little bit more. If you have major donors, those might have to be considered. Even if they only give you $1,000, we would never look at $1,000 before. Now it would have to be disclosed. If the donor is truly anonymous, then they can remain anonymous in the disclosure. It's all about the relationship. So continue to think about that as we go through this. If you have a hospital, those transactions do not apply. All right, so what have they said? Now we've talked through who's a related party. So what is required? Now you have to disclose the name of your related party, Megan Crane, the location, the city and state. So NACUBA has advised that they would put the city and the state of the institution in that line. The description of the related party, so you might say board member, and the nature and amount of the transaction. So if I have a pledge, it has to be disclosed. If it's the year I made the pledge and you've recorded contribution revenue, it has to be disclosed. If you bought stuff from my business, it has to be disclosed. Catching on? If there are truly none, you can add a sentence that says, there are no related parties as of this year, but it must be explicitly stated. Fun times, right? All right, here's what I think is super interesting about this. They don't care when it occurs. If it occurred in that audit year, so your reporting year, that's when it's going to be reported. So if I made a pledge 3 years ago and my pledge is still not paid off, then until I pay the pledge off, I would be on your schedule. However, if in that 5 years I'm paying my pledge, in year 4, I'm no longer a board member, I'm no longer a related party, I would be rolled off the schedule. So you literally got to look at it every single year in detail. Okay. And again, it's based upon the audited year. Okay. All right. So how do you respond to this? You're like, great, this is awesome. It's also May 22nd. So we're 10 days from some schools being done for the year and 40 days from the other. So what should you be doing now? Because this is effective July 1st of this year. So your audits submitted after July 1st have to include this information. If you don't have a related party policy, you should get one and put one in place. If you don't have a conflict of interest policy, you should get one and put one in place. You should be having conversations with your auditors. If we are not your auditor, please talk to your auditor about it. How are you addressing this? How are you testing it? It has to be audited per the department. So And then how are you communicating this with related parties? So if you have a major donor, I'm not your major donor, but if someone was your major donor, and now their name and amount has to be included on a schedule of related parties, how are you handling that? Okay. So you probably need to talk to advancement. Get them involved. Donna said she hated advancement. I don't know your relationship with them, but be thinking about that. This is gonna take a lot of people and a lot of effort to get these requirements met. All right, if you are non-compliant with the related party disclosure, you're required to post a letter of credit for 50% of the Title IV funds during the last fiscal year. So more money, more time negotiating that. Oh, but wait, there's more. Not only do we get to do it for 2024, it's comparative. So we get to go back and look at 2023 and include it. The biggest thing here is, again, how are you protecting personally identifiable information? So the department has said, no chance over your dead body will you send me personally protected identifiable or PPIs. Yeah. Okay, that's great. Oh, wait, hold on. We need the name, amount, location of these people. Some of that's protected information, right? So how are you doing that? Because all of your financial statements get uploaded to Easy Audit and the Federal Audit Clearinghouse. So it's public. So you can't submit private information to a public setting, right? Okay, so great. So now you need another schedule that has to be audited with an opinion. So now we've got to figure out, okay, materiality is, we've set one for the audit. Now we've got to look at the schedule. How are the auditors testing that? It should only be uploaded to Easy Audit, not provided out, so that you're protecting everybody's information, because it does have to say specific information. Okay. We expect your Dean Dorton client, there will be additional fees for this schedule until it ever goes away, which is probably never. So, all right. So which institutions should we see these related party disclosures implemented? All institutions with a fiscal year end of May 31st or later. For institutions with fiscal year end of June 30, 2024 or later, or any submissions not complete by July 1st, 2024. This is like a CPA exam question. It's like A and B, B and C, but A, but not D, right? Okay, 24% good job on item C. Any submission not completed. So if you're a 531 year in and you submit your related parties, or you submit your audit on June 29th, you're cool. You don't have to have the related parties set. Good for you if you're getting an audit done in 4 weeks. Proud of you. But no, it's any submission not submitted by July 1st of 2024. Okay, one other thing on this, there is the department so kindly released an FAQ on Monday night at about 5 o'clock, completely related to this whole area. It includes 3, 4, 5 questions with specific examples on related party transactions, etc. We're waiting on more guidance still on what they want the schedule to look like. You would think they would have a form. We haven't seen that yet. But there is an FAQ out there. If you want to read it, it's about 5 or 6 pages long. Covers this and a couple other areas. Okay. Moving on to the next portion of this. All right, mandatory and discretionary triggering events. So the department, 2 types. There you go. All right, so in the 2019 rules, there were 4 mandatory triggering events. So if that happened, you had to alert the Department of Education and say, this has happened to us, and then they would likely have some sort of review that says, yes or no, we want you to post a letter of credit, or we want you to take these actions, so on and so forth. Now there are 14, effective as of July 1, 2024. These triggering events apply to all institutions, nonprofit, for-profit, and public. So there's 2 purposes. One is that the department, again, wanted to have more control, more ability to act swiftly, but they include uncommon but serious situations. So those are the mandatory events where it's likely not going to happen to you, but if it were, then the department wants to step in more quickly, so that way they're not collecting millions on billions, right? And then the other item is to proactively discourage and dissuade bad behavior. So keep that in mind as we're going forward. All right, so these are the mandatory triggering events. I've tried to include if they are related to specific entities. So if it says for-profit only, it should be noted on here. But we're gonna roll through these and then we'll talk about the discretionary ones. So if you have debt or liability payments and a composite score of less than 1.5, and you incur a liability from a settlement final judgment. So if you're included in a lawsuit and you're calculated around 1.5, you have to recalculate your score. And if it results in a less than 1.0 on your composite score, then you have failed and you have to report to the Department of Education. If there's lawsuits related for anything, again, if there's a lawsuit in which the federal government has said, hey, school, you're not operating well enough, we're coming in and helping you or whatever, that's a mandatory trigger and you automatically fail financial responsibility, which means you're posting the letter of credit. If there's change in ownership, or ownership debts and liabilities. So if you are changing ownership and you have to pay a debt or liability related to settlement judgment or other matter, then again, you fail if your composite score drops down to 1.0. Okay. Again, these are uncommon events. That's why we're not spending a ton of time on them. I want them to be in your head that if you think, oh, that's a weird situation, triggers you to come think and look at these, but they're pretty uncommon, hopefully. If you have a condition in its agreements with a creditor that could result in default or adverse condition due to an action by the department, or creditor terminates withdrawals or limits a loan agreement or other financing agreement, you automatically fail. If you have financial exigency, so if you make a formal declaration of that, you fail. This is really uplifting, isn't it? I wish I had like a ticker for every time I said, you fail. If you put into receivership, you fail. So again, you're seeing, hopefully these are very uncommon mandatory triggers, but they did up them to kind of cover all those weird situations. If you have borrower defense recoupment, again, this is one where you recalculate the score, and there's a certain paragraph that's all recalculated under, and if you drop down to 1.0, you fail. So again, a lot of them are like, your score's great. Oh wait, you had this weird thing happen. Okay, recalculate. You're still great, cool. If you drop down because of it, that's when you have to report the trigger. Is that the one I just did? Yes, okay. If you have a significant share of federal aid in failing gainful employment programs. So we're gonna talk a little bit later about gainful employment. If you have a program that falls under gainful employment and you have 50% of your aid in those programs and the program failed, gainful employment calculations, then you fail the financial responsibility. Cohort default rate, what a joy. We look at this on every single audit. So if your cohort default rates are 30% or higher, you automatically fail. If you've been approaching that, hopefully we've already been having conversations with you about what you're doing. Most people are pretty okay these days. They were very high back when I started doing student financial aid because it was the 2008 financial crisis. And so for those couple of years in 11, 12, 13 or 14, sometime a long time ago, they were creeping up. That seems like they've come back down. So they should be okay, hopefully. But if they are higher, you automatically fail and you have to report. If you're required to submit a teach-out plan, either by the state, the Department of Education, a federal agency, anybody, you fail. If you're a for-profit, this one applies to you, your 90-10 calculation. If you derive at least, anyway, if you don't meet the requirement for 90-10, you fail. So uplifting. This is not my style. It's doom and gloom. If you withdraw owner's equity, you could fail. All right, so if you are a publicly listed entity, so you're a for-profit, these items apply to you. So if you are a for-profit and publicly traded and the SEC steps in and says, hey, yeah, you're no longer going to be registered with us, you fail. We're going to get to the more fun ones, I promise. If you contribute, if you're a for-profit entity and you put in a big owner's contribution to make your ratio look better at year end, and then shortly thereafter you withdraw it to make it so if you want your money back, you fail. These are all very common sense, right? But strategies that likely, if you're in a dire financial situation, you might consider doing. All right, so here's the discretionary triggers. So those were all very prescriptive, right? If you do this, you fail. If this happens, you need to report it to us. The discretionary triggers are designed to be open-ended. You get to interpret them. It could be a sign of financial weakness. It might just be an interesting situation. But they are a case-by-case look to whether it's a significant financial risk. So if you're one institution and you have a discretionary trigger you report, they may say, yeah, but that's not a financial risk to you. If you're another school and you have a discretionary trigger you report, they might say, oh, that's like, there's other things going on here. You are a financial risk. And so that's up to the department to decide once you report. Here they are, beautiful rainbow pattern. So it could be anything in here, a creditor action. So if Donna's team's coming down your pipeline, that could be a discretionary trigger. If you have lost your institutional program eligibility, if the state comes down for some reason, if you start closing locations, that could be a reason. So if you close small satellite location, maybe not a big deal. If you're closing 50% of your main campus, bigger deal, right? So it's all about how are you interpreting these? And this is a whole list of them. There are examples in the regulations, things to look at here. And I expect NACUBO to continue to issue more information as this goes on, and the FAQs probably to cover these. But like high dropout rates. So that's likely your cohort default rates probably going up too. If you also had just high dropout rates, those may be impacted and play together. All right. So Department of Education does have access to some, so they may say, hey, your cohort default rate's too high. But actually it's up to you as an institution that if any of those triggering events happen, that you would report them. You have 21 days to report a relevant action or event to Department of Ed. Okay, so these rules are effective July 1st, however many days from now. If you had a triggering event that has happened, or it's in place as of now, like, hey, we're coming to year end, we know this is in place, but it formerly wasn't one of the 4 triggering events, but it's existing as of July 1st, you have until July 21st to report to the Department of Education. So it's not just new things after July 1st, it's anything in existence that you would need to report. If you meet a trigger, there's potential options to make financial protection. Again, a letter of credit. I think the interesting thing here is if the department has said, hey, you have 4 triggers or 5 triggers, or you have 10 triggers, you might have to get a 10% letter of credit for every trigger up to 50%. I know, Mary, right? It was a nightmare. I really should have had that sound clip up for us. It's classic. Okay, so so you're like, okay, great. Now we have to have a letter of credit and the department's dragging their feet. So this is probably like 2 or 3 years down the road, but because they have to clear you, right? You don't just be like, hey, department, we're done. And they say, okay, great. There's a process. They have to say you're no longer a risk. And so for triggers that don't require recalculation, you can probably get released after 2 years of audited financial statements. What a joy. And if they do have recalculation, then once you pass subsequent submissions and pass the requirements, then you would get released from requiring a letter of credit. If you're a public institution, my God, here you go. There are new financial responsibility for public institutions. So if a public institution can provide documentation to the department that they have the full, faithful, support of their state government, you are financially responsible. If you can, which I'm like, well, what is that language? Who needs to sign it? We're waiting on all this information. Like, does it need to come from the gov or is it coming from somebody else? Like, who's it coming from? But in that case, that if you have the full faith and credit of the government, then you're cool. If you can't get that statement, you are treated like a private institution for financial responsibility. Okay, so hopefully you're not here, but keep that in mind. Okay, you could be on heightened cash monitoring too. Also, not 2. If you were a public institution that failed financial responsibility. Ooh, good times. All right, here we go. Financial responsibility composite score. So the 2019 requirements that have come out, like I said, I've been on the phone with the Department of Ed even this week. So working through the schedule, I'm not sure what they don't understand, but that's for them to figure out, I guess. But there are 3 areas that they've seen major challenges. Debt obtained for long-term purposes, leases, and then the supplemental schedule. So, you have your schedule in the back that says, this is our net assets without donor restriction. You have to have a reference that says statement of financial position or your net asset footnote, so on and so forth. Apparently that's causing problems still. Okay, so debt obtained for long-term purposes. It cannot exceed total property, plant, and equipment. It should also include lease liabilities with right of use assets, short-term portion of debt, again, up to the amount of PP&E. If you have short-term lines of credit and notes payable used for construction, it should not exceed the total construction in progress. So if you've got CIP, but you pulled a lot of money down on your construction loan, you can only add the construction loan back up to the amount of CIP. If you refinance debt, it cannot increase debt previously associated with purchase PP&E. So keep that in mind. There's a lot of limits. In leases, you do not have to show pre and post implementation lease amounts as the lease standard changed to right of use assets. So you just need to include the right of use assets information. Ooh, all right, transcripts. It was a nightmare, right? Okay, so the transcript precisions, these apply to everyone. So part of it falls under the PPA. So if you're a new institution, there's more rigorous process to certify institutions, but as part of the PPA changes, they've said, oh yeah, because I'm agreeing to participate in student financial aid, I will not withhold transcripts from Title IV students in certain situations. So this is the official code reference. So 668.14B33 says that you may not withhold an official transcript or negative action against a student for a balance owed by the student that resulted from an error. So if you have made a mistake, you can't withhold their transcript. But it can also, .14B34, requires that you provide an official transcript for credit and clock hours in which they received Title IV aid and all the institutional charges were paid or included in an agreement to pay at the time the request was made. So that's where it gets sticky, right? I think the first part, we can all say, oh yeah, we made a mistake. We got it. I don't think it's happening that often, but maybe. But the second part is the much more complicated part. So we're still waiting for terms on agreement to pay. The department did release an FAQ again Monday evening related to this. So there's some more information in there about what is an agreement to pay. It does include payment plans, but you can read that and see how you're going to apply that at your university. So what's the problem here? So the schools have said, that's the way we collected our debt. They said, I graduated. Oh yeah, you still owe us thousands of dollars. Well, too bad. We're not giving you an official transcript until you pay your thousands of dollars. The department believes there's other ways to collect on that money. I'll let you interpret if you think I believe the department or not. Just know I'm on team university here, okay? So that's what they're saying. But now they're saying, okay, you can't do that. And you can offer partial transcripts. So if you said, okay, you had Title IV aid in your second and third year, we'll give you your transcript related to that. But if you have charges from your first year that you didn't receive Title IV aid, we're not going to give you that. Well, whose technology team's on board with that? Zero, right? Okay. All right, so here's our next polling question. In response to the new transcript requirements, we plan to either A, no longer withhold transcripts, B, adjust our policies to allow us to withhold transcripts in certain situations, or wait and see if there's further guidance provides more direction. If that settles down. Everybody heard polling question and scrambling for their phones. Yeah, I assume, my guess is that there's going to continue to be pushback on the transcript regulations, right? And it's probably going to get held up in court at some point. And so I understand people saying wait and see, but you also have to comply as of July 1st. So running out of time to wait and see. So my guess is most people are probably going to on July 1st fall in category A. You're just not going to withhold so you can be in compliance. And then you're going to get further clarification. And then you're going to say, okay, this is what we're going to do. If you're a small school, not too many students, small graduating class, et cetera, you might say, yeah, we can parse through that. As transcript requests come in, we can figure that out. But most of you large institutions, that's just a nightmare. So, all right. Another October, again, the department really loved October this year. October 10th, 2023. The Ed published a final regulation that would provide the most detailed information ever available about what students and families can anticipate to pay for college. Again, because we've been in the headlines, right? It costs too much. I didn't know. I didn't realize what scholarships meant. I didn't know I'd have to pay that direct loan back, et cetera. Are you ready to implement these changes? Okay, still waiting on more guidance. We're seeing a theme, right? All these rules came out in October, pretty quick turnaround. Most people are still waiting on guidance. There was an FAQ released on Monday evening, related to some of these rules, so you can find them there, but there is one about, I think, gainful employment. It says like coming soon. So, keep that in mind as you're going through this. So it is effective July 1st. They've already delayed reporting to October 1st, 2024. And it establishes acknowledgements, warnings that, and a department disclosure website for 2026. So between now and 2026, the department's gonna establish a website that says, here's all this information. Oh, yes, these programs at this school do not meet these requirements, okay? But that's not until 2026. They gave themselves plenty of time. We have to do reporting for a couple of years, et cetera. All right, so financial value transparency. Kept saying fair value because that's, you know, the fair value footnote is just in my head, but financial value transparency. So the goal is it to improve the quality and availability of information to students. So what does it truly cost? What are the sources of financial aid? What are the outcomes of programs in that you receive Title IV from? There are two measures, debt to earnings, well, kind of three. Okay, debt to earnings and earnings premium measure. Those have been grouped together, and performance benchmarks. These FVT apply to gainful employment and non-gainful employment programs. That's an important distinction because there's also gainful employment rules that was in the same release. Those only apply to gainful. So this applies to everything. Oh, surprise. Gainful employment only applies to gainful employment programs. Gainful employment programs are all non-degree programs, so certificates, diplomas that lead to recognized credentials, okay? Just keep that in mind. Okay, so under FVT, a student is an individual who received Title IV funds. So if you have students that do not receive Title IV funds, you don't have to include them in your FVT calculations, and it's for a qualifying graduate program. So if you don't have graduate programs, good for you. Or maybe not good for you. Maybe you need more revenue. Maybe you need graduate programs. But if you do have graduate programs, these apply. They require institutions to report information about each of the students. So what's going to happen is that you are going to report how much debt each student has, and then the department is going to take that information and compare it to IRS earnings later down the road, and you're going to get a ratio, debt to earnings. You're also going to get an earnings premium calculation. It's a little bit different. We'll talk about that one in a minute. If they are total or permanent disability or have passed away, you can exclude them from your calculations. The debt to earnings ratio, again, compares the debt of graduate programs to the discretionary and annual earnings after completing the programs. They're based on annual earnings and then one based on discretionary income as based upon what's reported to the IRS. The earnings premium measure evaluates the extent to the graduate program out-earns the median annual earnings of individuals with only a high school diploma or equivalent in the same state as the program is located. So if you're in Ohio, you're comparing to high school students with a diploma. Here, if you're in Kentucky, different, North Carolina, Texas, wherever, et cetera. After the first 6 years, you may choose whether to report student-specific data, either using the standard methodology, which they are releasing information of, or a transitional methodology. And then the department is establishing this website, which will be up in 2026, which we all know that'll actually be like 2028 or 2030 or sometime farther down the road, right? They're going to delay is my guess. Okay, so what's the deal here? So if you have a program that fails financial value transparency, and you're going to keep the program around, and you have high school senior coming in and say, I want to, or even a college graduating senior, I'm coming to your program and I'm going to take geology. And geology is a super expensive program, and their earnings are that of, I don't know, a cell phone store worker. So maybe not in their field, et cetera, or they're not earning what they're supposed to be earning, et cetera. They have to sign a statement saying, I know I have not earned the amount of money I need to pay back the loans associated with this program. Who's going to sign that? No one. Also, I think you guys do a pretty good job of trying to tell them that up front now, right? Like, let's not finance your Friday night pizzas and stuff, but it doesn't track, so this is bringing that even more into effect. Here's more information about debt to earnings. So what happens if you fail? Again, if you have greater than 8%, and or you fail the discretionary, it's 20%. You have to fail both, so that's good. And this is how they calculate the median earnings. I know I'm going quickly, but we're almost out of time. So if you fail the earnings, there you go. You have to have notifications from the department to the institution. So the department will say, hey, school, you're failing these. And then you have to issue warnings to prospective students. You have to get those student acknowledgement signs, and your program might lose eligibility for Title IV aid. So keep those in mind. We're still waiting on more FAQs related to this. Do we have like 5 minutes, 3 minutes? Oh, I have 8. Okay, perfect. All right, so let's talk about Fair Labor Standards Act. The final rules were issued April 23rd. Guess when they come into effect? July 1st. Like they could have at least pushed past like the July 4th holiday, you know, like giving us a few days, but July 1st, here it comes. So it increases the minimum salary to $43,000 for exempt employees, $58,000. It increases again in January 2025. And then there's automatic increases every 3 years. So what's nice about the automatic increases is that you can sort of plan for it. You know it's coming every 3 years, as opposed to this, which is almost doubling that minimum salary. And you have what, 2 months, 3 months to respond to it. There is a whole resource on the Department of Labor's website specifically related to higher education. So the link is here. You have your PDF, it should be clickable. But there is a whole FAQ or a whole fact sheet related just to education. Oh, sorry. Couple people taking pictures. Okay. All right. So here are some, I thought these were interesting exemptions for common higher ed jobs. On that link, it gives a whole lot more information in detail about why these people may or may not be excluded. So read it, get comfortable with it. It includes teachers, coaches, professional employees, administrative employees, executive employees, and student employees. So keep that in mind. They've been nice enough to write a whole FAQ just related to higher ed, probably because we were all like, no. But it's out there for you to look at and read more about. If you are a public university and you offer compensatory time or comp time, whatever you want to call it, instead of overtime pay. So if you can earn time off, et cetera, instead of being paid overtime, it may not apply. Okay. Oh gosh, that was not 8 minutes. Okay, who has questions? Yes. Oh. Do I have one? Sure, I have one.
On the related party disclosures, a couple of weeks ago when the first Nakubo thing came out, it talked about those disclosures had to be in a footnote. They had to be covered by the auditor's opinion. So now, and they said, talk to your auditor about that, which is a big hairy deal for the AICPA, right?
Yes.
So now you're telling us the clarification is it could be a separate schedule,
Yes.
and you guys will, whatever firm will do a special purpose opinion.
Yes. Yes.
Okay, so that's the new, that's where we're headed. Good.
Yes. So if you were at the Nakubo accounting and whatever update, like mid-April, that's what they said. And then shortly thereafter, they came out, even after Sakubo, which was also shortly in that same time frame. They said, please hold for more information, it's coming. Nakubo has a 25, 30-page summary of almost all the stuff we went over today. That's the summary. The regs are like on page 70,000 of the Code of Federal Regulations somewhere. But when Nakubo released their guidance, which is what we as a firm at least always go to, because that seems to be best practice, they said this can be a separate schedule, but it will have to have, it has to be opined on. So it has to have an auditor's opinion with it. But it would be a separate schedule. So yes, that guidance is continuing to change. Other questions? Yes.
So your very last slide.
You have to talk to the people virtually and the mic.
So the very last slide, you indicated that if you have comp time policy, that it may not apply to you. So if you don't have one and you implemented a comp time policy, then they could resolve this issue.
It could. Good. I should have had, if you've ever been to a Dean Norton seminar and you've heard Erica Horn speak, she's a former, well, she's current attorney, anyway, she's got a law background, so at the beginning of every one of her presentations, she's like, these opinions are my own, they are not legal, they are not blah, 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 like, I should have totally put that slide in today. But yes, explore this, we're happy to have conversations, we have HR consultants that can help through it too, but probably want to talk to attorneys, et cetera, because that could be a big change, but it could exempt you on some level. Other questions? Okay, here's my information. If you ever need anything, please reach out. Even if I'm not your auditor or consultant or anything else, please, we're happy to help answer any questions along the way as we can.
Okay, welcome back, everybody in the room and everybody online. And so this one's gonna be a little different. We just heard Megan talk, there was a lot of talk about failures and a lot of scary stuff to watch out for. So no failures in this presentation. We're gonna just look at a component of financial well-being from the perspective of analyzing data, making data-driven decisions. So what we're gonna have is a little bit of a walkthrough, a slide deck walkthrough here of what topics we're gonna cover. Then we're gonna go into more of a deep dive demo. So if you were gonna take this back and start trying to draw some of these metrics out, draw some of the takeaways out with your own data, how would you start that? What would it look like? How would you proceed with that? What are some pitfalls? What are some gotchas there? We'll walk through what that looks like with this tool called Power BI. Everybody heard of Power BI? So we got a good portion that's heard of it, so hopefully it won't be foreign, but for those that haven't, we'll see how to get into it, how to grab it. There's lots of good stuff with it.
And can you pull the mic up closer to
Step there. All right. So the same thing, we're gonna have polls on this one. I think everybody's used to this so far this morning. Now, do if you haven't, and put it in Jordan if you just joined us. Those working remote, maybe it's easier to join the internet, OEB.com, Dean Jordan and select join. We're good to go there. We'll start with the introduction, the objectives here. So we're going to talk a little bit about the challenges in higher education, specifically at the topic here related to program profitability. Understand why data-driven decision making is important when we're talking about those college decisions, program decisions. Review of how we can look at that in a few different ways. And then we're going to get into what would be a good part of the presentation is actually going to be a deep dive with some data that we created for this exercise. And then a discussion of if you're going to take this back and want to get started with the group, how do you do that? So first, I'm Ed McGillis. I'm Associate Director of Data AI at Dean Jordan. So we do everything from custom app development, we do data migrations, data integrations, all the way to machine learning and AI. So you'll see that in a second here. All right, so the polls are working. So current data analytics strategy. Somebody came in right away with a weekend. So we email Excel documents, that's kind of our base level, right? We're scheduling and sending reports out of some line of business system or multiple line of business systems. We're creating and already sharing dashboards. The last choice thing, so more or less ends up being somebody emails a question. Somebody spends an hour looking that question up and then responds to it. Give that a few seconds. Right, so wind has dropped way down, which is great. No longer 100%. In the room, what do you guys, and I can't tell the room versus hybrid here? Emailing Excel, who picked A? Can't pick A. B, scheduling and sending reports. C, already have dashboards up and running. And then D, when there's the email request, we respond back. But nobody in the room on that, so the people that are doing that are remain anonymous. So I'm a heavy AI user, especially generative AI. And so I asked ChatGPT for this presentation, create me an image of administrators and business officers dealing with the uncertainties in higher education. And this, believe it or not, was the first thing it gave me. Does this resonate with anybody? So once I got this back, I asked him to explain why it drew this. And some of this might be a little familiar. So first it told me this is a group of administrators and business officers sitting around a table, appearing visibly worried as they analyze financial reports, showing warning signs and declining graphs. That's pretty accurate. The symbolism here, broken piggy banks, lack of savings or depleted funds, storm clouds representing an uncertain financial future, and then chains around the table, which I didn't even notice at first, symbolizing budget constraints and restrictions that are limiting financial flexibility. So I think we got it pretty good in one shot there. So that takes us to, if we are constrained a little bit on financial decisions, on budgetary decisions, on program decisions, how can we focus on data-driven decision making to help in our day-to-day decisions going forward? And so the areas that this can help us in, we have strategic goal alignment. So make sure the institutional goals are matched up to what the financials are telling us. Financial sustainability, this is forecasting which revenues, forecasting which departments, programs, colleges are growing, which are shrinking, how to make sure you're there for the long term. Improve student outcomes. So how do we use the data to figure out things like average students, student retention, students that might turn over? How do we make sure we're also, which this goes along with the next one a little bit, giving students the courses they need, the programs they need to succeed today? For example, if you look at a program that my group would be involved in, something like the data analytics, some machine learning, and AI program, a lot of those didn't exist, or they were very superficial even 10 years ago. 5 years ago, it got better. Now, a lot of institutions are offering some kind of data science, data analytics, data modeling, course program, major, and some have departments. So we've seen that blow up just because the market demanded it, which goes along with innovation and competitive advantage here. One of the trends in technology, how do we develop new curriculum, new programs that are going to tie in and increase our student enrollment? So the way I explained it, another poll question here, when you come to those decisions, when you're making financial decisions, are you using data-driven to back that up, or is it the squeak wheel gets the grease, whoever comes to your office the most? How does that look? That we're still moving here. All right, so pretty small on the not yet side. Occasionally, I thought that one might be the leader, but it looks like it is being adopted by regularly, so that's great news. And continuously, which is obviously that the part where it's hard to get to, we knew that wasn't going to be a leader there, but it does show, there's, if you pick that, what it is, instead of data-driven decision making is, how it is important. And you're using it regularly. So the point of this one is just to dive a little bit into one area of this. So if we look at program profitability, it's one tool for data-driven decision making. It gets people a little nervous. So certain groups, certain departments, certain colleges, sometimes it's hard to look at what the people, the staff, the professors, the heads have distilled down into single numbers of what do you return to the institution. So what's your share of the pie you're bringing in, or what's your total share of the expenses? Certain people obviously already see this, but making that public to more members of these groups is sometimes more of a political exercise. And the way we kind of bridge that is that we present this as, when we look into this program profitability, it's presented as one data point in an overall view of what a program does for the institution. It's not the end all be all. There's other things involved. There's strategic objectives. There's courses or programs that might be paramount to the institution's purpose. Just because those aren't producing bigger pieces of the pie doesn't mean they're not important to the institution, both for reputation, for research, and so on. With that said, there's a few different ways we can look at this, and then we'll walk through a little bit in the demo. So, one, the break-even metrics. So if all things hold, or if we put a standard multiplier on expenses, what does my enrollment have to be for a program in order for me to hit break? From there, you can go on and project, what does that look like over the next 5 years? Is that been declining? Is that been increasing? At what date do you think this program might be in trouble? Contribution margin, comparing basically the revenues, primarily tuitions and fees, from a program to the greater institution, see what percent of that institution's numbers are created from that program. And then what if analysis. So the demo that we'll run through just really quickly is going to show if I have enrollment in the department, how does that scale my revenue? While we'll run through this rather simplified, in practice, this what if analysis can help you make decisions of starting new programs, pulling back funding on certain programs or departments, and kind of guide you to that financial stability. So if we're looking at how to draw the program profitability, we have a few things we need to pull from. We need to figure out revenue. That's supposed to say minus this expense. We have expenses, administration, wages, support staff, so both going to be direct and indirect. Student information system, learning management system. Primarily we want our course metrics so you can see how many semester credit hours we have across each program. That's really our defining metric when we're going to see what each program produces. We can also pull in things like housing cost deals, what revenues come from there, and then administrative overhead that we need to balance out across the different programs. We won't get into it in the demo, but you can pick a few different ways to spread out indirect expenses and overhead expenses. The weighted way to do it is using that credit hours marker as your overall production. So if program 1 has 100 credit hours, program 2 has 200 credit hours, you could do that to say, well, program 2 gets 2/3 of the expenses, program 1 gets 1/3. Those can be really nuanced conversations that would involve a lot of back and forth between the groups. There's obviously the idea of supporting programs. So if one program requires you to take courses in another program, I can count things like athletics, especially when it comes to scholarships when you have people in certain programs. So this can get as complex as you wanted to, and we'll get into how to keep that from paralyzing you from moving forward on this when we get to the end. You have to finagle this monitor a little bit to be able to do this. Give me 1 second. So what we've done is we've created a base set of tables, and it might end up being a little harder to see the audience here, hopefully are online. But we've created data sets they're gonna let us manipulate and look at some ideas here. So this first one is students. That's not too bad. But everybody has a student ID. We generated 5,000 students here, all random information. None of this is real. But we have areas in case we want to eventually go down and do geographic diagnosis. And then we have enrollment date, tuition fees, what college and department they're under. They can tour the rest of them real quick. Our LMS is going to be departments, name of the course over here, how many credit hours, and also which student got what grade. So we get a fairly lengthy data set. It's probably our biggest, I got 25,000 rows here. And then we have our department list. Some of the small school. And general ledger, so choose a little bit here, and I'll start revenue and expense alternating for all the categories. For every department. All right, so before we jump in, a quick start on Power BI. So, like I said, this is free. Even if you're just toying around with Excel documents with feeds from systems, I would recommend getting this and just play it on your own and seeing what it can do. My bar went there. So if you go to powerbi.microsoft.com, it's going to throw you over to this page. Now, what this page does is it wants to sign you up for a subscription. When you're just starting out, you don't need to do that. I would recommend you do that just starting off. If your organization already has a Power BI subscription, that's fine. You can take that on there. But what you should do is go to products and look for something called Power BI Desktop. So Power BI Desktop is where most of your reports and your dashboards are going to be made. And the benefit of Power BI Desktop over trying to get apps up and running is that this is free. So it has no license. It has no recurring cost. You download it, and we'll throw you an update every month. But this is going to be basically the tool that we use for most of the analytics work we do. And it can handle everything from a simple spreadsheet, which we'll see, to more advanced, some more advanced analytics, so some machine learning, you can do regression predictions. You can load, we have R, scripts you need to run against your data and run all that. So you can go from the infantile to the very complex. So at the very least, go download that, see what you think, try it out on some of your data. This is what it's going to look like. Just to give you a demo of what it looks like when you're starting out. There's a lot of stuff here, right? We're going to walk through a demo with somebody is, but the easiest thing you're going to do is you're going to say get data. For us, this is going to be text. Go to where the data is, and if I want to pull in ledger, for example, it's going to go look at that file, that spreadsheet, that export that you pull from a different system. It's going to connect to it, and then it's going to give you a panel. It says, okay, this is what we think it is. There's gamma. It looks like this. Does this sound good? Yeah, we're going to say, yeah, we're going to load that. Now, what you do is you end up doing that for all of your inputs there. What it does behind the scenes, it not only loads all of ththose rows from your CSV, from your cell, from your direct system into memory, but it's creating a data model of how they're related in the background. Instead of one of the medium ones here, a little bit of the big one. So if I go just add one more, I'm going to add. So if I go pick another one that's not really used, I go ahead and load that in. So loaded 5,000 rows. we created this demo data set here with 5,000 students. And if we look at the modeling here, should have done is give us our entities. Now, once we pull all 5 in, what happens is it automatically detects the relationships between our data sets and figure out how those should be connected. So you don't have to sit there and be loading the 125,000 row one. We're going to switch over to one I've already. And so this is what it ends up looking like. This is kind of small. Each of these represents a file, and then Power BI creates these relationships between them. So date, obviously, that's the one on market, the date of the general ledger entry. Colleges and partnerships, we have a relation there. We have a relationship to the LMS, and the students also connected to LMS. What colleges and departments they're enrolled with is well. This guy on the island here, we're gonna show that later, so don't worry about them for now. All right, so how do we go from those spreadsheets we just showed and the flat data into some kind of organized look at the financials that we want to touch? That would go back to what we call the report view here. We're going to create just a matrix view, which is just a fancy table. For this one, so with all these visuals, basically, you're going to feed it fields inside of the data set that you want it to pop. Some people will probably like this, some people might not have seen this before, might have questions, so please feel free to ask them to go. But I'm going to pull over from my main rows. I'm going to pull up, I want my college name, and I want my department name to be here. Second for generates. Okay, it's tiny. We'll try to make it bigger and then we add some stuff in. That's there. Okay, so now let's go with we want to look at revenue, so let's start with tuition. Up there. We'll just pick up a few of these. So we can put it on the screen. I'll make it bigger here. We'll grab total revenue. Then we're going to grab expenses here. Supplies. Again, just by putting it here, Power BI has already filtered this out for me. It's figured out which is involved with which department. And then let's have the next one. Next. Try to work on making this a little bigger. You guys make that out. Without publishing this, it's hard to get the site right. But basically, we have a listing here of each of our departments across collated by college name, tuition revenue, gifts, and revenue total, wage expenses, maintenance expenses, expense total, and then what our net total is. So I'm going to point these out in case they're not coming through clearly. Art has a net total of almost negative $2 million. Curriculum design has a negative $2.2 million. And computer science also has close to a negative 2.2, biology negative 2.7, everybody else is in the green here. So this is one way to look at just a quick glance. And likely you probably already have something similar to this where you're pulling from systems, you're pulling in general ledger data. You have some way of appropriating indirect expenses across college departments and obviously assigning direct costs. And this, we're not going to go into how to do that, but of course, credit hours are kind of the production metric of these groups. We can use that to divide this. But what we will look at is we'll dive into, if we want to look a little further than this top line, what ability does having this data in a model and setup like this give us? So we're gonna look at students first. It's gonna be matrix of the so that part is I think was big. So same kind of thing, we have colleges linked. So we can look by. College name. Oh, I'm sorry. It's actually from department, so same idea, the college name, department name, and rows. For our values, you're actually going to use student count here. I'm not ready for students. It made it as small as possible. Of course, there's no way to zoom in on this. So it's going in and it's giving us basically our student count against each department, revenue per student total. Slightly different way to look at what we did before. For this one, we're not rolling in tuition, we're just looking at a sum of revenue. So to get some interesting things like art industry, having very high outliers, we would then go and look at what happened. In this case, these are outsized gifts to the department that have been divided on the students, but you can pick the metric or create a metric that best represents what financial point you want to focus on. More than likely, it's going to be multiple. And then once your data is in here, you can do, I'll show you a quick demo. This is a Power BI demo, but more than the data itself. But I can open up Q&A, so I can enable my non-technical users who aren't necessarily developing this software, developing these reports. I can give them a portal to go in and look at something like how many students are in science. So sometimes it's done. Students. Can't tell this is not on the laptop. All right, so that one, so I can just ask free-form questions, I can get answers back, I can have these applications for me. Nothing too crazy. So now let's go through an example of what it looks like if we put a little what if analysis on something. And we modify, in this case, we're going to modify student enrollment. So we have, you kind of see that. So this is student change here. This is going to be our slider. We project negative or positive student enrollment across the program. These are our base numbers here. So these will keep us right now. They're looking at the entire university. That's pulling out revenue, expenses, the new, which is the variable we're going to manipulate. This exercise is going to be the same at the top for now. And obviously student count is going to be the same also. We haven't changed any of that. Let's create a cluster column here. Make this big, this one should show up a lot better. We got to pick our axes. Stick with department name. X. Y, we're going to look at should go look right away. We're going to throw expenses on here also, since that's going to matter. And then focus in on one, so it's not overwhelming. So we picked art. What we have here is the revenue for art versus the expenses that are allocated to art. What we're gonna do is we're going to project a change. So right now, art is underwater, I don't know, $2 million. What happens if I increase my enrollment in art by 1.8? Do that, we go to our parameter, you guys saw on the island earlier, where we're showing the data model. And we have new department revenue here, you add that in, and that's gonna project what that new revenue is, based on whatever we tell them. Right now, we're taking all revenue, just divided that by the number of students and coming up with the revenue per student. If you're doing this in practice, you want that to be a little more articulate, focused on what you know moves the revenue driver, and also taking into account how expenses scale based on that. If you had 100 new students come in, and in a department they had 121 students before, obviously you're gonna have wages go up. You're not gonna go up. So you also add those as parameters to your what system is. What if you lose students, we go negative 100, we're looking at 21. That's not a pretty picture either, right? So you can do the break even analysis through here. I'm gonna guess I wrote this somewhere around 5. This one's not what they need that. So let's see. So right in there. It was. Yeah, well, so I have an increments of 5, so probably about 17 student increase. If all of their expenses held steady, that would be your break even. So a couple other ways just to look at the data. It'll take us the next 7 minutes here before we do it. Again, once you have this data, the important thing is to explore it, which is the title of this presentation, explore program profitability. See what things stick out as outliers. See what jumps to your attention. For this one, we're going to do revenue versus credit hours here. We're going to use a good old scatter plot. I'll get this one as big as I can so it actually shows up. And do a graph. Part of the revenue on X. Why? We're going to want this legend of the department. Look at it. These points are going to be pretty small for you. Let's throw in a student count to be able to do a better. Okay, there. So now we're looking at departmental revenues on the right, on the x-axis, from 15 million to 18 million, and we're looking at it by credit hours, so total production, each of those groups. So you would expect people on the right side of department revenue to be up here in this quadrant. But we also have a lot up here in this quadrant, a lot of credit hours that are not producing. What is it? No, that's the other one too. But we have, if we look over here, we have some that are outstanding with producing revenue, but they're on the bottom of the credit hours. So they're creating revenue with less credit hours. So we have management and school business here. There's 249 students. Then we have finance. So the school business is doing great. This was completely randomized data set though, so I'm not picking on any program. And then we made it big, so they get to the third angle. Look at this. We just made each bubble sized by the student count. So you can see our two businesses are about in the middle. We have a big outlier here, small outlier there. We can easily go in and see what that is. My big outlier is computer science. Small outlier is curriculum development. So this one we want to look at for a few reasons, right? We already know they're negative net. They have a big student enrollment, producing a lot of credit hours, but they're kind of in our middle here, maybe not a standard deviation out of it. We look at this just from a slightly different, let's look at, instead of revenue created, we'll get that on the x-axis. We'll pull in and let's pull in the nets. So look at the net after expenses here. Obviously, you see few problems here. We have this group. We got close to negatives, or our negatives that are still the high number of credit hours. But we can change that and put that up. Let's say we want to look at revenue per student, so a different metric. Again, we're taking into account everything, and we got a whole new picture of that. So, biggest space is over here to the right. Biggest space over here to the right. Programs that are profitable, revenue per student that was low, outlier here, very profitable program with a very high student history. That's one of the ones we pointed out had large influx of gifts that are showing up here. So really it's multiple ways to look at the data. Again, with purely random data, you created the synthetic data set. You're not going to see the trends in this presentation that you'll necessarily see at your institution. But with just that dump of those 5 files, or department info, or student info, learning management system, general ledger, we can start graphing using visualizations to look at patterns, to really identify what things we need to talk about when we go to that data-driven decision. So these are just pieces of the information that you go and have this discussion about. Before I go off of this, that's it for the deep dive. Hopefully it wasn't too deep, but if anybody have questions on Power BI or how it creates these?
What kind of file does that save as?
So this saves as a .ppix, which is the Power BI data format. It's actually, if you change it to .zip, it actually turns into a zip file where you can look at the data model itself. What generally happens is when you go to share this, we've just been talking about the desktop, which is what this is, the desktop tool. You share it to your organization's Power BI tenant, they call it. And then you go to powerbi.com, and most people would consume this from that website. And so 1 or 2 people would be in charge of the desktop tool, they would update it, and then you would publish it out for the rest of the work. That's the piece that costs about $10 a month. It's not bad. You get a lot of use out of it. And again, this is free. If you guys have sample data set from previous synthetic data, happy to be mined from the threads on your own. You know it is today. I'm sure everybody has an open schedule in a few hours. Right? It's a lot of what my group does, and it has tie-ins everywhere, so I do like to show it. Right. Right, so that's it for the deep dive. Last poll. We got about 10 minutes here. Last poll. Are you using program profitability in your decisions now? We have a way to determine it by groups to determine it. Just about 1/5 or 1/4, not yet. So lots of opportunity there to play around with what we showed. The middle 2, solidly there, about 3/4 if you are, you're occasionally directly using it. The minority of your consumers. Right? All right, so how to get started? From a technician's point of view, this question is a little easier for me than it is for you guys in practice. Certain colleges and departments are going to be very protective of some of their data you're going to need to create this picture across the landscape and make sure everything's being weighted evenly and you can really see what these numbers look like for the institution. So we got to start by getting champions. We're going to start by explaining this is not the only metric, it's not the only decision point that's used to determine whether a program is valuable. This is just a data point in a data-driven decision-making process, right? The middle one, what I didn't show you because it would have taken days, the real data set is really, for me, it would be 80% of the work. For you guys, that first step might be 80% of the work. But how do I link all this data together? How do I eliminate data inconsistencies? How do I join up the data? It's spelled out in one system and KY in the other system, things like that that you're going to trip up on. A lot of the work is getting the data pulled in, cleansed. We call it data munging, which always makes me hungry when I say that word. But how do you get it to a point where you're able to report on these insights? Then the second, last one here is implement and iterate. So come up with something simple, maybe even that first dashboard, if you didn't have it, where it's gonna list all my colleges, programs, profitability, and then explore from there. So explore things that you see that stick out in the data, anomalies you want to look into, then create something to look at those. And then that will drive what you really should be producing. Pretty close to that on time here. We have the Power BI question. Any other Power BI or just page questions or how to go about creating an analytics footprint like this? I know I'm the last thing before lunch, but I think this is a good opportunity.
9 or 8.
Hey,
So I've not used, so I've not used Power BI, so how did it recognize the relationship in your data? And how did you know that it would,
sure.
in uploading?
So that loading process, the window pops up for loading. What it does is it looks at the data sets in each column. So even if they're named differently, I have student ID in one, student ID in another, and it's going to realize, say with an LMS, it's a one-to-many relationship. The student information system is going to give you one row for student ID. My LMS is going to have all the courses that it's taking. So it recognizes not only the link, but the relationship of one-to-many that you've been used when you go. If it doesn't, you can actually drag and drop and it will create for times of code. I'd say about 70–80% of the time, it pulls it in automatically. With this synthetic data set, since it's clean data and it's perfect, it pulled everything in.
We got a virtual question. How do you evaluate fixed cost across program profitability?
Yeah, that's one of those, it's a decision for the administration. So, if it's you want to try to develop it across credit hours per group, there's a few ways to make that decision. On the technical side, when you're building this, you can put all of it. So it really doesn't matter how you decide it. And Betty might be a better person to ask about how to lay that out across groups, but once she tells you how to do that, I can help you make it pretty use of that stuff.
So we've been through some good times and some difficult times. And today's discussion could be about one of those difficult times, as a matter of fact. And so we're going to look at understanding how a cyber event kind of folds out and how to deal with that, the recovery piece of that as well. We're going to learn from one another's experience because, as the lunch discussion proved, MSU is not alone in having a cybersecurity event. So please feel free to jump in at any point, interject, share your painful memories and how you also dealt with this as well. So we will learn together from that. And then hopefully this will allow all of us to maybe be better prepared and reduce the risk of this happening in our organizations. But even if it does, and statistically speaking, it will happen eventually. It's a matter of scale, I suppose, how to deal with that. So that's what we're going to try to achieve over the next hour. So before we get started, let's introduce ourselves. And Patrick, if you go first.
Sure. My name is Patrick Gonzalez. I am currently the Director of Cybersecurity and Compliance at Morehead State University. Been at the university going on 20 years. Prior to filling this role in January of 2022, I was the Director of Applications Development at MSU, and before that, a systems program on that team.
Good afternoon, everyone. My name is Guy Koji. I'm the cybersecurity practice lead for Lindorton. I've been working in the industry for 20 plus years, a mix of corporate experience and consulting experience. Very glad to be here today with you.
My name is Kevin Cornwell. I lead our IT audit and compliance practice at the firm. On the compliance side, and we're really not going to get into compliance too much, but just as an FYI, compliance is what you want to do before, and hopefully reduce the risk of this happening. And it's also something to be mindful of during, but, again, when you're going through that event, there are a lot of priorities, and compliance with one of them isn't always the first one. So as a matter of fact, ideally, we're hoping what we cover today is information you will never need, but in the event you do, hopefully this will help with dealing with that impact. And so we've got Patrick here, who has lived and breathed and survived. And, and it's not an understatement to say that there are a lot of MSU employees still on the payroll because of his and a whole large group of team's efforts. So Patrick, we're going to turn it over to you and share your pain with us.
All right, thank you, Kevin. I don't know how good of a storyteller I am, so I'll back up just a little bit before I launch into the nightmare, as it were. So prior to me taking over as director of cybersecurity, there were years and years and years at MSU where a lot of technology debt had built up, and over, a lot of IT leadership had come and gone, and a lot of things had been overlooked. A lot of budget constraints had forced us to overlook a lot of things and just cross our fingers and hope that we could slide by unnoticed. But unfortunately, in 2022, I started working, actually in 2018, I started working with Kevin, and we started the first semblance of a comprehensive risk assessment, the first time Morehead State had ever done that from a cybersecurity perspective. So we started inventorying applications, we started analyzing third-party risk, we started looking at where the gaps were, in our security posture, weighed against best practices at that time. That continued, after I took over in 2022 officially, we continued to do that. And I feel like, leading up to, the summer of 2022, we had a pretty good idea of where our gaps were and what we needed to do. And it was just a matter of getting funding and getting the manpower and the talent and the time and the staff to begin addressing those in a very methodical manner. And so that's what we did. And we had started down that road. We had started forming the first official, formal cybersecurity program at Morehead State. But unfortunately, the bad guys beat us to it. We were making good strides. I think we had our arms wrapped around, what our critical operational assets were, and we were beginning to put controls in place to protect those. And, we just got beat to the punch. So to start the story, I'll try to tell this from my perspective. I was actually, after many, many years of trying to vacation out west in Yellowstone, I finally got the opportunity to check off a bucket list item, and my wife, myself, and my 16-year-old son were actually in Red Lodge, Montana at the time, after having a fairly nasty flight out. We were in an Airbnb, and I got up one morning and I was enjoying a cup of coffee, looking out over some beautiful country, thinking this is going to be a good vacation. And what do you know, my phone rings. And so it's one of my security analysts, Blake Nickel, calls me and says, "Boss," he's like, "I hate to interrupt you. I know you're probably having a good time with your family." He's like, "But I think we've got a problem." And I was, okay, set the coffee down, we have a short conversation, and he begins to tell me about what he's seen. And so the way our attack manifested itself on the morning of July 12th essentially was, everybody showed up just like a normal business day, but we started getting reports that users weren't able to log into anything. Everybody was calling and saying, "Hey, I can't get into even Blackboard." Some of our cloud services were seemingly offline to the campus community. And so immediately, the systems administrators, the infrastructure folks just assumed that there was a directory services problem, and they started troubleshooting. Several hours went by with no avail. They're not able to find anything. And it was before this that Blake had started looking and reviewing that evening's alerts. We're an O365 school. We've got Microsoft Defender XDR deployed. And he started reviewing some of those alerts and quickly came to the conclusion that something wasn't right. There were numerous alerts of malware and potentially ransomware on several of the endpoints on the university campus. And so he brought this to the attention of our CIO, Rick Phillips, and said, "Hey, I don't think that this is a directory services issue. I think we actually are under attack or, something has happened in the early morning hours. So one thing led to another, they started looking into that as a potential thing. And then shortly thereafter, apparently one of our systems administrators came and delivered the crushing blow. And that was that it appeared as though the attackers had managed to gain access, get into not only our primary infrastructure, our critical services like Active Directory, our domain controllers, but they also managed to get into our backup systems. And at that time, it was believed that they had deleted the entirety of our backups, our actual productive working systems and the backups both. So when I got the call, Blake was kind of relaying all this to me saying, he's like, I'm pretty sure, we don't have anything. All of our virtual machines, all of our T1 production server workloads are gone. They've been deleted. Everything's offline. The entire infrastructure was as though, because you can imagine you just coming home and someone burning your house down, and so the question I had for Blake at the time, having been working on this, he and I together for the past couple of years was, do we have a viable copy of Colleague, the university ERP system? Is there a copy of it somewhere? Please tell me there is. And he said, right now, we don't think so. And so, to me, I about spilled my coffee, sitting there because I'm thinking, wow, if that's the case, then, this is an extinction level event for Morehead State. There's no way we can recover and continue business having lost 30 years worth of institutional data, all of our financial data, student transcripts, everything that we need to be operational. So when I ended the call with him, he told me, Rick will probably be calling, the CIO will probably be calling to brief you, as time goes on. But I just wanted to give you a heads up. And I said, well, try to find out, go try to find out and make sure, that we either do or don't have a viable copy of College and then let me know. And so at any rate, a few hours go by, and I think during that time, the entire campus community and probably most of the city of Morehead, given the economics of a small town like that, collectively held their breath, waiting to find out, at least those of us close enough to the attack to kind of know what it meant, kind of just held their breath, waiting to know, okay, will there be a fall 2023 semester? Will there be any more semesters for Morehead State? Fortunately, after about 4 hours and a call from Rick Phillips letting me know that I needed to get on a plane and fly back home, to help navigate through this, I was informed that there was a possibility that they had found a backup copy that had been misnamed and the threat actors overlooked it because it had been misnamed. But we were looking at about 3.5 weeks of missing transactional data that would have to be reconciled before we could put it back into place. And they weren't sure at that time whether the integrity of the data was good or not. So I quickly started making calls to DHS, FBI field office in Louisville, contacts at CISA asking questions. Okay, I think from where I said, I think we've been hit by potentially a ransomware attack. Right now, it doesn't seem quite like a ransomware attack to me, but I'm looking for advice. I'm looking to know if we can determine who the threat actor was. Can you guys assist possibly with encryption, decryption keys, et cetera, et cetera. So as I started making my way from the West Yellowstone airstrip to Salt Lake City back to Lexington and back to campus, I was in constant contact with those entities as well as the university, trying to just gather as much information and relay it and distribute it out to our help from the FBI and CISA and DHS so that they knew what was going on and they could provide advice along the way. So as it turned out, I think they did discover, I think I was actually landing in Lexington when I got a call and said they do think that we've got a backup and it is viable, but we're not sure if we can make the timeline and reconcile all the data, because this was July 12th. Our classes started second week of August. So we were just shy of a month out from having to start classes, and there was absolutely no infrastructure and no student data at that time in anything, no directory services. Everything was, imagine your entire IT infrastructure just burned to the ground, and that's where we were. And so arriving back on campus, I first met with Rick Phillips, to get a final briefing. I kind of exchanged information with him on what I had gotten from the FBI and DHS. And then we directly went and met with our president, Dr. Morgan. And, his question was, obviously, how do we navigate this? What are we going to do? And so I'll stop there for a second and, I'll say, in all of the preparation leading up to that, we had only just begun to put together in draft an incident response, a formal incident response plan. We had been focused so much on actually even making backups of critical assets and putting detection and awareness and things like that in place that the actual incident response plan that we had was essentially in my head on a draft piece of paper and completely untested. And so between myself and Rick Phillips, we kind of sat down, we had a few conversations, and then we met with Dr. Morgan. And my advice at that time was, okay, based on conversations that I've had with everybody up to this point, our critical operational assets and the things that we need to protect most are our academic and our administrative functions, teaching and learning, obviously, which I think is the same for everybody here. If you're not providing, teaching and learning, and or in some cases, maybe if you're an R1 research institution, that functionality, the teaching and learning, getting that reestablished, all of the IT technology that's required to support that, so that if we can make that available to our faculty members prior to the start of the term, maybe, just maybe, we can get business rolling, we can get our students here, we can get them in the classroom, and we can go from there. And the second thing, obviously, is cash flow. We've got to make sure that all the administrative functions, the business office, technologies that support collecting tuition dollars and getting financial aid issued out to students, all of that stuff works. And so that's the approach that we took to prioritize the response to the cyber attack, just focusing primarily on those two things. And so to do that, we kind of split people up into teams, and we said, you're focused on this, you're focused on that. And we just went to work. And so essentially that was our incident response. The first time we, had ever tested it, everybody was notified at that time. We knew who the players were, but we put it into practice, kind of just in time, so to speak. So I don't recommend that. It's not a good business practice. Try to spend some time, working all those details out ahead of time if you can. But no, I'll go back and I'll say, the attack itself, while we quickly identified, the threat actor as being the Akira ransomware group, on several of our machines that they had managed to get control of, they've made an attempt to encrypt some of the data. In some cases, they were successful. In some cases, they failed. But they left a little ransom note behind, indicating, who they were and what they were after. The problem was, in essence, they had botched the attack. And I say that because, typically, most of you probably know, when there's a ransomware attack, it typically follows what's called a double extortion model. They will get your data, they'll encrypt some data, and then try to get you to pay them to unencrypt it and give it back to you. Or they will steal your data and threatens to post it publicly on a leak site and then try to get you to pay them to keep from exposing that data. And so while all of the indicators of compromise for a typical ransomware attack were there, what threw us off was why they basically backed out and did a slash and burn, seemingly. Because at the time when we discovered that they had deleted and destroyed all of our working operational infrastructure, there was no reason for us to even have any conversation with them at all. The only thing that we could do at this point was begin to rebuild. There was nothing that they could have taken, that they could have given back to us, that would have allowed us to get back up and running. That's how severe the damage was. And so because they destroyed our backups, a lot of our logs were gone. So our forensics investigation of trying to piece together the attack and how it happened and where initial access took place was kind of sketchy. In the end, we ultimately determined that they essentially had compromised one of our systems administrators' accounts and came in through a Cisco ASA appliance. We had just replaced our edge firewalls with a new set of Palo Alto firewalls, but for some reason there was an old ASA appliance that was left on the network without MFA on it, and they had managed to compromise one of our sysadmin's password. They came in through that ASA appliance, and then we already knew we were fairly soft in the middle because we hadn't got there yet. So there were a lot of server workloads that needed to be updated, probably a lot of vulnerabilities on both software and web interfaces that have been around for several years that hadn't been addressed. And once they got in, it was very trivial for them to just move laterally, pick up credentials, escalate their privileges, and then begin to move out onto the workstations and just do whatever they wanted. And eventually, we assume somewhere, we don't know for certain, they managed to lift a set of domain credentials off of one of the other servers. And once they had control of our domain controllers, it was over. But in essence, we were completely and operationally dead in the water when I returned. And, we had 1 month essentially to take those two priorities and work on getting just enough IT back up and functioning to support those two objectives. And so my advice to everybody is that, if you have a warm and fuzzy feeling about your cybersecurity program at your institutions, and that's great, But I will emphasize that it is of the utmost importance that you open channels of communications with those folks and ask questions in plain language. Ask them questions about, how sure are you, that our backups are protected? How sure are you that, if we get hit by a cyber attack, what is our mean time to recovery? Should we suffer the worst possible attack ever? Are you guys confident? And if you're not confident, talk to us about what you need, and what things need to change in order for you to be confident. Because, no matter what we do, no matter how much time we spend, how much money we spend on this kind of thing, how many controls we put in place, we can never reduce risk to zero. And so it's always a matter of when, not if. And then are you prepared? Is your institution prepared to be able to just stand your infrastructure back up and continue with business? Or is it going to be, a nightmare like it was for us? And as we started into this, where we were looking at, there were probably about 15 to 20 of us on the core team. And we worked for an entire solid month and a little bit beyond, working 18, 19, sometimes 20 hours a day. And going home, you go home, you lay down, you can't sleep, of course. And so you get, a couple, maybe an hour or so of sleep, you jump back up, you throw some coffee back, and you come back in. There were several times when all of us just had to pause and say, okay, we have to take a day. Everybody, you go home and sleep. When you come back, we'll rotate off. And it was like this, for a solid month. But, I have to say, the outpouring of support from not just our city, the city of Moorhead, but the campus community was something that I had not seen in many, many years. I mean, the collaborative effort and the camaraderie that formed around this was, if anything, a light at the end of the tunnel, a light in the darkness, so to speak. We had people bringing us food, we had people, offering, assistance, everything. And, that just wasn't typical. We had a lot of, siloed departments that really talk to each other a lot, and this changed all that, for the better. And so, yeah, and we managed to open school, just a little bit late with a few hiccups, and starting into the fall term, there's probably not time in this whole hour to go into all of the things that continued on with our cyber recovery, but suffice it to say, our help desk received tons and tons of calls every day, and we just essentially split out people and tried to address the key things, the big things that were interfering with operational capacity and efficiency over the next 4, 5, 6 months.
Thank you, Patrick. So at this point in our case study, Moorhead exists. They're going to continue. They survive, but still in kind of a recovery format. So Guy, we'll take a step back, and I know a lot of times you will get that call, like Patrick did, or right after Patrick gets the call, and you will get involved. What do you see as far as similarities between Moorhead's experience or things that were different?
First, I want to thank Patrick again for coming here and sharing his story. It used to be a little bit of a stigma when the organization got hit with something like that, but really it's no longer the case. That is happening to every single organization. It's just a matter of scope and scale. So should that be a foodborne ransomware attack, an account compromised, phishing emails, regardless of what you call and determine as an incident, it's happening all the time. So I wanted to say that as just a few words on that topic. I think we can replace Morehead State University with any higher ed education institution, right? Because it's such a common state. The first word of Patrick, well, we had a lot of technological debt. We've never had the time and resources to focus on cybersecurity. These are two very important parameters. And a lot of organizations feel that way because budget is an issue, because there's so many other things, because we're moving to the cloud, because of the cost pressure, et cetera, et cetera. Not focusing on cybersecurity is no longer a choice, right? You can do that at different pace. Not everything costs money. A lot of time, you can focus on processes. Patrick talked about the incident response plan, and we're going to explore that a little bit more in terms of what can we do to prepare from the process standpoint. But this is unfortunately a very typical story, and not just for the higher end industry, right? It's across all industries.
I think, one thing that Patrick mentioned that's worth, I'll say, reemphasizing is the bad actor there did a slash and burn. There's not much money to be made in slash and burn tactics, and this is a money-making industry. So that's very atypical. Normally there are, when I say easier paths, paying a ransom is one path. Not going to recommend that path, but also usually in that scenario there are, maybe some salvageable backups. But anyway, so just reemphasize, MSU's scenario was probably more dire than most. So Patrick, at what point did the dust settle enough that you could take a breath? Felt like it had a little bit of breathing.
Yeah, it was right around, I think, mid-September, I think, of when things started to calm down enough to where we could kind of go back to a normal schedule. Mid-September, would you agree? Roughly.
I took a breath when we realized we had that.
Yeah. But no, mid-September, I think we were still struggling a little bit with, with various things, just the ancillary things, the ancillary fallout, the indirect results of having all that infrastructure gone. Some of the faculties, some of the departments were calling saying, we were using this or that particular server for our teaching in our labs, and it's no longer there. Can you guys help us with, getting something set up, just to expedite this? And so as you can imagine, once everyone realized that they were still going to get paid and life was going to go on, then it was back to, okay, let's focus on our stuff and and so those requests started coming in. But mid-September, that started to become much more normal, much more manageable. Once we had critical infrastructure back up, we started seeing cash flows coming in to accounts, and Dr. Morgan was really happy to see the money flowing again, and students were in class and teachers were teaching. And so, we checked, we met our objective. We started to turn. Now let's deal with all of the other things as they come in, prioritize them as they come in. So yeah, mid-September, so probably a month and a half or so after the attack was when we finally got to where we could breathe a little bit.
All right, good. Now, how long after that until you'd say, or maybe you continue to say, we've recovered?
Well, it's funny you say that because I had a conversation, just before I left yesterday, and we are just now, there's still several remnants. One of the remnants are we had to deploy several hotspot wireless access points across campus in order to facilitate getting wireless access points wireless access into buildings for teaching and learning and for business activities. And we're just now probably, I'm going to say next week, I think, getting ready to go back and decommission those and replace those with our actual commercial production wireless access points. So there's still remnants. And, the biggest thing that drug out the longest was because of the complete and total destruction of our Active Directory. We were a hybrid Active Directory environment, meaning we had an on-prem Active Directory that synced up to an Azure Active Directory. And so all of our, a lot of our authentication, some of it was on-prem, some of it was in the cloud. And when they destroyed our on-prem Active Directory, it broke the trust relationship with our Azure Active Directory. And so all of those basic Active Directory objects, your user account, my user account, and all the device objects were orphaned from the on-prem environment. And so they would continue to function just so long as an account didn't need a password reset. If you reset a password, then the account would go disabled. You had to go through this arduous synchronization process. It was fairly complex and oftentimes required us to actually work with the student or faculty member to get it to complete. And so we had to start doing that immediately with the users. Once we got our Active Directory on-prem up, we had to start doing that. And it took us until almost, let me see, it was actually in January of this year that we finally finished those. And all we could do is in small groups, and when the students came back, we kind of did an A through N thing, A through Z, whatever, and just grouped them up. And, we would get them on the phone and just walk through individually resetting their passwords. Additionally, as you can imagine, because we had a lot of lateral movement, we had to re-image about 2,000 workstations all across campus. And so we had to go out and hire some contract help to come in, round up those machines, bring them in, re-image them, just to make sure that there weren't any threat actor remnants or any, C2, artifacts left over on those machines.
It's interesting, you mentioned contractor help. What kind of external resources did you bring in?
Yeah, very, very good point. So, as Mary mentioned at lunch, on the way back from being out west, Rick Phillips, our current CIO, had been through a cyber attack in the UK. And so he had some contacts with both Microsoft and Dell that he had called upon. And so when I arrived, Dell was already on site and Microsoft showed up the next day. And as I said, as I was just mentioning at lunch, they were a curse and a blessing. Had we planned to call them and utilize their services as part of our incident response plan and had those conversations in advance, it would have worked out fantastically. Unfortunately, they showed up and took a look at what they had to do and just immediately went to work. And we didn't have the resources to assign to them directly. And so they started building infrastructure, putting security policy in place, building group policy objects, doing all sorts of things. And none of our guys were able to shadow them. And so more or less, they left us with, they said, there you go. There's your new infrastructure. And myself and my security team will probably be backing off and adjusting some of those security policies for another year or so to kind of balance security against operational efficiency, because some of them were just outright becoming. I mean, it's because, to their credit, they were like, we've got to lock this place down right now for these guys. And so that's what they did. But had we been able to have that conversation in advance and have that as part of the incident response plan, we could have kind of buffered that or softened that a little bit, where the downstream ramifications of those security policies wouldn't currently be causing us as many issues as they are.
Gotcha, thank you. So you mentioned earlier that you prioritized putting in infrastructure and processes over completing the incident response plan with the hope you had more time. So that's one of, and not that was the wrong approach, or you may not even want to change that, but based on that example, would you have developed the IRP sooner, or what other lessons, what are the takeaways do you have?
Yeah, no, absolutely. Very, very good question, Kevin. I think, looking back now, if I were to be able to go back to January of 2022 and start over again, I think it's very important. One of the lessons that we learned, quickly is, and the challenge, I'll say it this way, the challenge for a lot of institutions, whether they're building a security program or they're trying to improve their posture, is you look around and you see all these different frameworks. You've got NIST, you've got the CIS Top 20, you've got all these different frameworks that are designed to try to methodically guide you through developing and improving your security posture. But even though in those models, it's emphasized, do an assessment of your critical infrastructure. Find out what's most important to you. A lot of times they don't tell you how to go about having those conversations in plain language with people, because, I can be an IT, as an IT employee and look at something and think that's very important. But from a business person's perspective or someone in the administration, I may be way off base. That may not be a piece of critical infrastructure that is prioritized under what I've decided. So, you've got to get in a place where you can ask those questions, open up those channels of communication, and get to the point early on as you begin to develop your incident response plan, identify exactly what is the core of your business that you're trying to protect, and build the IRP and the program in conjunction with each other, side by side as you go along. Because once you get the core protected and you've got an incident response plan you're building out, what if this gets attacked? What do we do? What is the bare minimum that we have to get back online or preserve in order to continue and survive? Then you can start building your program out from that. And that incident response plan has to be developed in coordination with that. And the two things will inform each other, I feel like, as they go along. One will inform the other. And so you end up with a more solid incident response plan and better protection that's prioritized around the actual things that matter.
Right.
And so for a lot of us who are budgetarily constrained, that's key, is understanding, at least when you first start, what do you focus on and what are you going to spend your money on where you see the biggest return? Because, return on cybersecurity is kind of like insurance. You begrudgingly pay it, but you don't really get to realize it until you have an incident.
It's not worth it until the day of pain, right? All right, so let's talk a little bit about what you can do before a cyber incident occurs, or to reduce the risk of a cyber incident. Fortunately, we've had a long-term history with Morehead State, and we've worked on projects like PCI compliance and GLBA compliance. And there are pieces of those projects that have helped, and Patrick's already mentioned one or two of those that had a direct benefit. But in and of itself, compliance, it either points towards an incident response plan, as in do one, basically, either that or, again, like any other compliance, it's an exception if you're not, it's not an exception if you are doing it. But these compliance rules, they're geared to help you identify what you should do. And so some of the elements I think are particularly useful and would be for any organization are those inventories that Patrick was mentioning. So we have to do a data inventory. So what data is being stored and where is it being stored? Simple questions. However, universities are I don't know why the image of an octopus just jumped into my mind. They are many arms and not always connected real clearly, and finding what's where is a challenge. So, but anyway, the data inventory was intended to identify PII, student financial data, HIPAA, potentially, federal grant, confidential type data, and where it was located. And so obviously that's got a direct input into an incident response program, just knowing the impact. In MSU's case, almost everything was impacted, but at least they knew where it was. The other one, and this is pretty common across all compliance requirements, is an IT risk assessment. So I guarantee you on MSU's IT risk assessment, in the controls or risks related to incident response plan, those were listed as a high risk until that plan that Patrick was working on got out of draft mode and was approved and officially in place. So the IT risk assessment identified that need. And that's just one piece out of potentially 100 or more control risks. So that roadmap is supposed to align or be derived from that risk assessment. And again, we all know we're dealing with budget constraints. So you can only take one bite at a time. The risk assessment is not intended to be something that you fix the day after you get all that information. So again, it's prioritization, but at least being aware. And I know, Patrick and I had some conversations. I know he was communicating those risks on a very frequent basis and not making a whole lot of progress until this opportunity came. I hate to call it an opportunity, but it was an opportunity. and it changed minds. I wish it took less than that to get us to, sometimes be able to do what we know we need to do. But again, time and money are limited. It's just not going to happen without the right motivation. So anyway, some of the things that can be done ahead of time would be to make sure there's a good inventory of data, systems, people, and have a risk assessment in place. And the reality is the risk assessment is something we're all supposed to be doing anyway, not just because it's a good idea, but because we have Title IV funding, and we have to. Just a little nudge there. So that's any suggestions on what are the things you could do ahead of time to help?
Well, what we always recommend when we work with institutions is to do ongoing cybersecurity assessment. So Kevin mentioned the IT risk assessment, which is at the process level. When we do cybersecurity assessment, we look at the systems. We try to identify vulnerabilities similar to what threat actors are going to try to find and exploit to get into your network. We also advise on doing penetration testing where we emulate specific kind of attacks on a real world scenario. We, unfortunately, I would say, work in incident response as well. So we learn a lot from techniques and tactics that threat actors are using to get access to your data, basically. And so we use these techniques and tools in our assessment methodology. And when we work on pen tests, we want to make sure that the organization has the ability to detect, monitor, and stop these simulated attacks. Something else that we would recommend is exercising the incident response plan from a technical perspective. So looking at also these potential indicators of compromise and reacting to them, but also having the executive team, the cabinet involved in the response. It's like you're training for a marathon. What Patrick and team experience is running a marathon with, hey, here's a bottle of water, good luck. When you train for a marathon, you're training your muscles, you're training your body, you've got a plan. And so the more you can practice that as a leadership team in terms of making this decision, contacting the FBI, having forensic partners on contract with whom you've got a relationship with, knowing what tools you can use, how you're using them, etc., etc. What communication are you going to send to your employees? What if email is down? How are you going to communicate? How are you going to ensure payroll? All of these processes, they have to be discussed, and you have to train your organization, your institution in that response process. And that cannot happen with doing that once a year. It's an ongoing process. You need to have a plan, you need to bring all the executive team together, and you have to work through different scenarios. And we partner with a legal counsel to help us with this kind of session. So that, we got that legal perspective as well. Patrick mentioned accessing the sensitive data, extracting the sensitive data. That's all kind of privacy regulation that you have to comply with. So these are my two responses.
So Patrick, there were between July of last year and today, there were a ton of technical improvements made to improve the security program. What are the ones that the users noticed, the impact on them? Training is a good example, but the actual things you put in place that changed the way users behave or were able to perform their duties.
Yeah, so probably, but prior to our cyber attack, we had almost no endpoint management across them. It was just kind of scattered. There were a few machines that we had under some semblance of, endpoint management that we could control policy, push updates to. But a lot of it, because of COVID, during COVID, when we had to close our doors and go home, it was decided at some point by someone, and I'm not sure who, to just let the users take those machines home, but give them administrative access to their own machine so that they could install whatever they needed, they could do whatever they needed to do to continue teaching and learning remotely. And so as you can imagine, making a user an administrator of their own machine opens up a lot of risk, gives the threat actor an in, and there's really no need if I can get on the machine that I have, administrative privileges on the machine to do whatever I want. And so during this time, when we were suffering the attack, we knew we had to bring all those machines in. They all had to be re-imaged. So we capitalized on that and enrolled all those machines into Microsoft Intune. And for the first time ever, we probably have 98% of our machines now, all of our workstations, in Microsoft Intune or in what's called Mosel Manager for the Apple devices. And so now, not only can we make sure that all of those workstations are patched and up to date, the browsers, the operating systems, but we can also push policy out and monitor, the activity on those machines such that if someone downloads and or triggers a piece of malware or they click on a phishing link, then it's automatically reported and the analysts in the SOC can respond to that. And so then that's ongoing every day, as many organizations know, phishing is rampant. And so typically on a week, we'll respond to, 50 to 75, cases of someone clicking on a phishing link, making a mistake. But that has gone drastically down since being. So to answer the question, I think endpoint management has probably been the biggest return on our time investment since the cyber attack.
Right, good. Do you have something there?
And something that Patrick wanted us to work together on is kind of validating that these controls were working effectively, right? So that was part of the project that we've done with Patrick, is coming in and doing a specific assessment and validating that, yes, these controls were in place. The team was able to see what we were doing, catch the attendance, response to that. So that was very interesting because, yes, there were a lot of new controls. And so that was exciting to be part of that process, but that's your job.
Yeah, I had one thing, and I don't know if you caught the, I don't know the severity or the, I keep going back to the word opportunity. I'm just blaming for being an optimist. So picture those 2,000 machines that Morehead had, and instead of machines, they're cats. And you've got to give them all vaccines. The difficulty of the task and the personnel involved to give 2,000 cats vaccines is daunting enough that any organization dealt with that will kick it down the road. And again, we've seen this exact same scenario play out in other areas where it may not be a cyber event, but it's just some change that needs to be done in the environment to reduce some significant risk. So, but if some opportunity came along and there's catnip and it draws in 2,000 cats into one place, you don't waste that. And so they were able to accomplish in a short amount of time under normal circumstances. One probably would never happen, but could have easily taken years to accomplish. And that one change, I think Patrick made this point, that one change alone probably reduced 24 different high critical risks to the environment down to a low risk, from very high down to a low risk. And on top of that, that's a particular change that most higher ed institutions is a hill they will die on when they start discussing it with the academic side. They want free liberty to do whatever they need to on their machine for the purpose of education, and it's a valid point. But the risks obviously outweigh the benefit in most cases. And that was probably, Patrick, correct me if I'm wrong, probably the only scenario you are going to get that done.
Yeah, oh, absolutely. Yeah, and even now, we fight for that daily. There are, obviously, every institution has their outspoken faculty members. And so we hear from those regularly, I can't do anything on my machine now because, you've done this, you've locked it down so tight, I can't teach, And I do my best to try to listen to all those and sit down with those faculty members and look at it and try to get them to explain to me, what is it that you're doing? What are we doing that's blocking you? And then we try to compromise because, enterprise security is about a balancing act. It would be really easy for me to just flip on all the switches or leave on, leave all the policies in place that the Microsoft detection and response team put in place before they left. But it's just not realistic because those faculty members in a lot of cases have a valid point. It does disrupt their ability to do certain things. And so what we try to do is we try to group those off and categorize the risk that they pose to the institution by allowing something. And then we try to compensate for that risk in some other way.
Are you a gatekeeper?
We have to be.
Good answer. Have to be. All right. So, Patrick, one last question before we open up for the audience for questions. What are the big takeaways? What advice can you give other higher ed institutions that maybe they can take away and help move the needle in their environment?
I would say again, I keep going back and I have to emphasize, that a lot of times I feel like in just, talking about peers at other institutions, it seems like the common theme is there's somewhat of a disconnect. There's not really an open channel of communication between the IT folks who like to make word salad out of acronyms and talk about, highly technical things, and the business office from which they're requesting money to do things with. And so, I have to keep saying, I advise each institution to make an effort to open up a channel of communication with your IT folks, specifically if you have a cybersecurity program, and kind of figure out a plain language that you both can speak so that, the business office who's in charge of being fiscally responsible for the institution's funds can know as much as they can know what they're paying for and what the return is, because if I come to you and I say, I need this, and I start rattling off serial numbers or some type of hardware or software, you're not going to know what that is. And that's just the IT speak. And so I think it's important to have a place, that IT and the business office at least can come together. And hopefully if you have a CISO, your CISO is capable of translating that. If not, set up those channels of communications and have those conversations so that you understand what's being asked for and why it's important. And more than that, I think the rest of it will take care of itself if you're able to hire people who are passionate about protecting the institution, and they just need to have the tools that they need to do it. And a lot of times that's the challenge, especially if you have budget constraints and you're looking at other things that, if we spend money on this, we can immediately see our return on investment. But if we give all that money to these cyber guys, they're going to do some stuff and maybe it'll protect us someday. So it's kind of hard to get people begrudgingly give money to, cyber defense controls when you can't immediately see what that return on investment is. So if you've got whistleblowers, if you've got people who are saying, hey, I've identified a bunch of risks that needs to be addressed, at least take the time to listen to it and find out if what they're saying is legitimate or not, because it could definitely save you, from a full-scale major attack that's more costly than purchasing that control.
Yeah, a lot of, Morehead State University is really fortunate to have somebody like Patrick leading the program, right? A lot of institutions do not have dedicated information security professionals, or they may, hire somebody to reset password, to look at a few logs and say, okay, this is our security person. It doesn't work that way. Security is highly complex. Mentioned compliance requirements, the GLBA, PCI, all kind of things that needs framework. You got all that cybersecurity responsibility, operational security education, being able to communicate to the cabinet and the members of the executive leadership, etc., etc. It's hard for one person to be able to be good at writing policies, managing the firewall, and being there 24/7 to watch logs and hope to catch a cyber attack. It's a losing battle. We help a lot of institutions with what we call the Information Security Office program, where we help that person that maybe was hired to do some kind of security services, or we help the IT department to co-source or outsource their security program. Because we'll bring to the table team of experts with specific specialties in all the different areas that institution will need working with Kevin's team and other important teams to provide that service. So that would be a major takeaway. I don't think that we've got the security covered because we've got a security person on team, or we've got somebody that we're going to train. It's impossible to do that way.
I agree. Okay, with that, I can turn it over to any questions, or and if anyone's been through something similar, your take on this would be very helpful.
Did you get to go on that vacation? Yeah.
No. There you go. Not yet. No, I would say we're coming up on the 1-year anniversary. And someone at lunch mentioned going to Yellowstone. I'm like, I tried to do that last year. So someday.
Long-term ramifications.
Yeah.
We did get a virtual question. Have the hackers been identified?
So we had a question virtually. Have the hackers been identified?
So based on the indicators of compromise that we found on several of the workstations, we attributed the attack to the Acura ransomware group. So beyond that, I mean, I think you can Google, and they've been pretty prolific the last couple of years. They've hit, several small businesses, large organizations, healthcare, higher ed, and they just racked up a very, very long list of victims in the last couple of years. And so, unfortunately for us, they didn't follow the normal ransomware playbook and ended up destroying so much infrastructure that they just took themselves out of the game as far as us ever having any plans or whatsoever to communicate with them or negotiate with them. So, yeah.
Do you mind sharing what the direct costs in response to this was? You don't have to.
I'm gonna repeat the question. The question was, what was the direct expense to recovery?
Well, right, she can answer.
We have someone in the room who can answer that. And you don't have to.
To date, I think we're at about $1.5 million. But part of the attack, we decided to pivot to a SaaS environment for a colleague. And so we still have another about 1.5 million in future expenses. So we'll be right about the $3 million mark by the time it's all over.
Yeah, we made the decision, probably, as a result of the near extinction level event that to get our crown jewels, so to speak, off-prem and up in an Amazon Web Services data center so that they could worry about backing it up and distributing that data so that we didn't ever have to worry about it being in, one or two places where it could be, irrevocably destroyed or lost again. So,
All right. And so Mary and Patrick make a really good point there. When it's a scorched earth, sometimes you don't build it back the way it was. You build it back the way it should be. And so are those costs recovery? Yes, but they're also investment costs. So it's not like $3 million are going down the drain by any stretch of the imagination. So those are investment costs too.
That's a good point. Part of that 1.5 was buying new servers, about 600,000 of them.
And no, those
Equipment.
that
It's not
was
really-
brand new equipment that got replaced. It had a life, that's age on them, some time on them.
yeah, we had the opportunity to make up the technology debt during that time, and so we did.
Okay.
Did you have any cybersecurity insurance? And if so, was any of that covered?
No, and I'm glad you mentioned that because, a couple of years prior, we had begun to have a conversation about cybersecurity insurance. And at the time we were in conjunction with that conversation, we were about midway through our risk assessment and assessing the gaps in our own security programs. And I was very passionate about not taking out a premium for cybersecurity insurance at the time, because any cyber company that would have insured us probably wouldn't have insured us if they did a thorough assessment of our infrastructure at the time. And so I felt like, and I pushed for taking that money and allocating it to putting those controls in place and then reassessing and come back and adding that later as a supplemental, once we had a base level of control in place, because we were kind of starting from nothing.
Any other questions? All right, looks like we're good. Well, thank you very much for your time.
Welcome back. Picture a tightrope walker poised high above the ground, carefully navigating a narrow path fraught with unseen dangers. With each step, they must maintain a delicate balance, constantly assessing the risks and adapting to the ever-changing environment. In many ways, this is a challenge faced by higher education institutions today. Like the tightrope walker, you must navigate complex landscape of risks, from financial challenges to safety concerns, cybersecurity threats, and reputational hazards. One misstep could have you in serious consequences, but with a keen understanding of the risks and a proactive approach to managing them, you can confidently stride forward in turning potential pitfalls into opportunities. Today, we will explore the robust risk assessment process to help your institution maintain a balance and reach new heights. My name is Jody Wren, and as a former chief audit executive of several organizations and the current assurance services associate director with Dean Dorton, I have worked with numerous organizations to harness the power of risk assessment for informed decision-making. In our time together, we will delve into the key components of an effective risk assessment, from identifying and analyzing risks to evaluating and mitigating them. We'll look at real-world examples and case studies that demonstrate how institutions can successfully integrate risk assessment into their strategic planning and decision-making processes. By embracing risk assessment as a valuable tool, you'll be better equipped to prioritize resources, adapt to changing circumstances, and capitalize on emerging opportunities. You'll foster a culture of risk assessment throughout your organization, collaboration, and this will help enhance the risk assessment process. Whether you're grappling with financial sustainability, ensuring academic quality, or safeguarding student well-being, the insights hopefully that you gain today can help you make informed decisions that align with your institution's mission and values. So let's step to the tightrope together and discover how mastering the art of risk assessment can help you achieve the perfect balance. I will start off with a disclaimer that these slides are really based on my research, the reading that I have done throughout my career. They're my opinions, based on experiences I've had, based on things I've read, based on trainings I've attended, and do not necessarily represent, Dean Dorton as a whole. I think they're necessarily wrong, but just wanted to provide that clarity. So our objectives today are to discuss highlight the importance of risk assessment, especially in the industry that you all are in, and really in any industry. To also provide practical strategies for implementing risk assessment. We're going to demonstrate how risk assessment supports decision-making in a case study that we'll be walking through, and hopefully convince you to embrace risk assessment as a valuable tool. Baked into my presentation, some of the research includes the COSO, which is the Committee of Sponsoring Organizations, ERM
strategies that they have out there. So COSO was an organization that was created as a result of bank failures in the 1980s. And they came forward with a lot of thought leadership in the area of internal control framework. And an internal control framework that they came out has become a best practices, so much so that when we had the WorldCom and NCOM failures in the 90s, it became codified as part of SEC regulation for publicly traded companies. It's always been considered a best practice and has stood the test of time. But when you think about an internal control framework and how risk assessment is including in that, COSO used the depiction that they used was a pyramid where you had your control environment at the base of that pyramid. The control environment meaning the tone at the top, the strategies and objectives of an organization basically being the foundation for that organization. The next step in the control environment or in the internal control structure was risk assessment. What will prevent us from achieving those objectives and everything that we've spelled out as an organization? And then from that risk assessment, you then implement control activities to help you mitigate the risks that you identified in the risk assessment. You have information and communication that's going up and down the chains within the organization. And then you have monitoring. And so the ERM, because risk assessment was such a key component of the control environment, ERM or the COSO group came out with subsequent, work and research and white papers on enterprise risk management. And they took the pyramid and turned it into a cube, basically emphasizing that risk assessment, the control environment, risk assessment, the control activities, the information and communication monitoring, more like a cube, but it needs to happen at every level of organization, in every department of the organization. And I'm like picturing this cube in my head, and every location within the organization. So sometimes if you're a scattered site, just because you have controls and things implemented at yours as an overall, that may not be occurring at the site. So it's important that the risk assessment not be just single focus, but very broad in looking at the entire organization. The next piece of thought leadership that's kind of baked into this is the Association of Certified Fraud Examiners 2024 report to the nations on occupational fraud. So you may be thinking, how does fraud play into this? Well, in addition to looking at, some of the typical things that you would look in a risk assessment, putting fraud into that process is also key. The Association of Certified Fraud Examiners issues this report every 2 years, and they base it from information from across the globe, from fraud professionals across the globe, report back to them what type of fraud they're seeing and how is it impacted, how much did it cost, where did it occur? And this is fraud that occurs within the organization. We're not talking about people doing fraud outside stealing from you. This is employees stealing from you, all levels of employees. And what the ACFE does is it goes through and dissects and reports out the industry the frauds were reported in, and we'll talk about in higher education the results from this, the gender of the people doing it, the age of the people, the locations, like where is it occurring, just departments, and then also information on how was it detected. And so it's a really good thought leadership piece that I always encourage people to go. So we've got a few slides that have information from that most recent survey in here. And then the final piece of thought leadership, and I have a list of references and resources at the end of my presentation that I use, but is the Institute of Internal Auditors 3 lines of defense model, which is what the IAA produced in response to the COSO internal control framework. So it's nothing different. It's just how do organizations implement the COSO model in their institutions, organizations, and do it in a very methodical manner. And so the 3 lines of defense kind of help companies break down the best way to do that. So this first slide is one that came from the ACFE report, and this shows the effect or fraud based on industry. So it's really, I know it's a little tiny to see, but on here, they show that education up in the top corner had for the so they received about over 1,300 cases that they evaluated. 70 of those cases came from higher education, and the median loss for those frauds were around 50,000. And again, this is what was reported. As I mentioned, the report's done in the 2-year time frame, so they were probably putting out surveys in fiscal year 2022. So these were probably frauds that occurred in 21, 22 time frame. But this kind of shows across industries, what is the median fraud that occurred and how many cases are we talking about? And I think keeping this in mind is that, you know, one of the takeaways is there's no industry that's free of it. You can't just say, you know, because I'm in higher ed, nobody would ever steal from us. Our employees love us too much. They're too committed to our mission. They wouldn't do it. It's unfortunately not the case. And another reason why it's important to include it and incorporate it into your risk assessment. So what exactly, what is risk assessment? Think of a risk assessment as a way of looking at your college or university and identifying things that could potentially derail your success. It's like giving the institution a thorough checkup and spot any issues that may cause problems down the road. You start by making a list of all the possible risks you face that, you know, could possibly come your way, and you, such as drop in enrollment, funding cuts, operational concerns such as data breaches, campus security incidents, and then you consider the risk on how it could affect your reputation, like, you know, academic misconduct, mishandling, just all of the things that could impact your organization from achieving their objectives. And the purpose is to lay them out and have conversations. And one thing I like to mention is that it's very important to include people from across the institution, not just your finance people, not just your executive leadership, but you want to include individuals from across, even down to faculty members. And if you're really progressive, maybe students, just to kind of help you think through what could go wrong. When I was at Kentucky Higher Education Assistance Authority and Kentucky Higher Education Student Loan Corporation, one organization, we implemented ERM. And I think one of the great takeaways as we were going through that is each department created teams and talked about the risks that could impact their teams down at the department level. And then we brought all that information together, and then you can kind of start seeing highlights where at Kia, you know, we had our grants administration and we had our default servicing and our customer service area. I mean, we just had a vast number of issues that may not all have the same one, but there could be some common themes. For instance, human resource issues, turnover, retirements, those kind of things. So it's very important not to just do it in a isolated format. You want to kind of open it up so that you have all of those risks forming together on a risk registry. And so then the first question comes into play as, what framework do we use? I'm talking through, you know, as I mentioned, the COSO framework, but there are other frameworks that you can look at to help you in the process. And I'm going to kind of go through some of the benefits. So for the COSO framework, it's been around for a while, again, committed or developed by the COSO organization. And I didn't explain this, but COSO was a group of industry leaders that came together to work on the issues in the 1980s. So we're looking at the Institute of Internal Auditors, the American Institute of Certified Public Accountants, the Financial Executive Institute, PricewaterhouseCoopers, and I'm sure I'm not thinking of everybody, but so it was those kind of stakeholders that were included in that COSO community that helped do all this thought leadership. So they developed a framework using a comprehensive approach to managing risks across the organization. And then it aligns risk appetite with the strategy to enhance the response effort. So there's multiple things that are looked at as you're performing the risk assessment. ISO 3000 or 31,000 was created by the International Organization for Standardization. And again, it provides principles and a framework and a process for managing risk, and can be used by organizations regardless of size, similar to COSO, regardless of activity or sector. It just helps organization increase the likelihood of achieving their objectives and improve identification of opportunities and threats. The NIST risk management framework was a framework developed by the National Institute of Standards and Technology, and they provide a very disciplined approach, but also integrate information security and cybersecurity risks into their framework, which can be done with COSO, but NIST was the first one to really develop some checklists and things to kind of help with that process. And then the RIMS risk maturity model was created by the Risk and Insurance Management Society. And it has been around for a while as well. And it helps organizations identify risk for improvement and create a roadmap, to advance its effective. And it has more of a insurance spin. So I'm pretty sure like cybersecurity insurance providers probably have something that's sort of following their model to help them. Obviously, they're trying to minimize risk, so they have to pay out fewer claims. But if you don't have anything to use, it's a good one to use. So what areas are included in a risk assessment? So some of the areas we're going to walk through is, financial risk, operational, reputational, and strategic. So financial risk factors that could negatively affect an institution's financial health, for example, include enrollment drops, government cuts in funding, which would give less money to support the institution's goals going forward. Operational risks that might be included on a risk assessment for a higher institution include some of the cybersecurity, the computer systems being hacked, sensitive data, student data being stolen, which could cause obviously a lot of chaos, as we heard in the last presentation. Reputational risks is another place that you want to look at, and some of the areas that could affect that would be a professor being caught plagiarizing, mishandling serious student complaints, could also have a bad impact on the reputation of the organization. And some examples of strategic risks include maybe you're deciding to launch a new degree program and based on research, but then nobody signs up. Or when students graduate with that degree, there's no jobs for them. So that could be another area that needs to be, considered and looked at, and where controls need to be put in place to help manage that. So once you've worked with people from across your institutions, stakeholders, board members, whoever it is that you want to have included, and you come up with your list of risks, the next step would be is actually looking at the steps included in the risk assessment, from, again, identifying the risks, analyzing the list, analyzing them, examining them in detail to understand their nature, sources, and potential impacts. This could involve including factors such as likelihood and impact, which we'll talk about in a little bit. Evaluating the risks, prioritizing and identifying the risk based on potential impact to the organization, and benchmark that against the risk appetite, which we'll talk about a little bit later, and is a very challenging subject, I think, for a lot of organizations to kind of get their head around sometimes. Then how are we going to treat the risk? So where are we going to either avoid the risk, risk reduction, how are we going to reduce that risk, Are we going to share the risk, maybe getting an insurance policy, like for example, the cybersecurity policies? Or are we going to accept the risk? Because some risks may be out there, but it's going to cost way too much to control it. So why would we do that? So one example could be in accounting, in the accounting area would be what checks require 2 signatures. Probably don't want every check to require 2 signatures, but maybe there's a certain threshold of $50,000. Any check over $50,000, you want to have 2 signatures. That's just one example where you could elevate that risk. And then monitoring and reviewing, continuously monitoring. A risk assessment is not something that you complete, bind it, put it on your, put it in your bookshelf or save it in a file on your computer and never look at it again. It needs to be a living, breathing, changing document. So once you have all of your risk and you've done some analysis and you've gathered data to help you put things and kind of get them in an order to look at, how do you want to measure them? And then these are 3. So most commonly you see likelihood and impact, but a lot of the thought leadership out there now is also including velocity, which I think adds a really good measurement to the risk assessment. So likelihood refers to how likely is it going to happen? So when you're evaluating likely, it helps for the institution to prioritize their risk management efforts and determine what exactly, how fast do we actually think it could happen, or when would it happen? So for instance, a data breach, how likely is that to happen? In this day and age, maybe a little more frequent than we think, or a natural disaster that could impact customer operations or, the institution's operations. Impact refers to the potential consequences or severity of the risk event if it occurs. So again, an example could be if you have a significant drop in enrollment, what is the time it takes for that to really impact to be felt? Assessing how quickly that risk could materialize and how rapidly the consequences would unfold. So that's when you're looking at impact. Velocity is looking at if the risk happens, what is the timeline for it to be a really bad thing? So for example, in the previous session, when they talked about having all of their computer files deleted, that was felt immediately. And that was huge, a huge impact to the organization. So some velocity might be more gradual. For instance, I know there's a lot of talk about the student number cliff. The cliff is coming where there aren't as many students, maybe even that were even born to even be in school. So some of that can be planned for and maybe look out, or other things like cybersecurity risk. If it happens, it could shut down, operations and make it really challenging. So now we're going to kind of walk through some examples of some risks in higher education. Obviously, reduced government funding or budget cuts, declining enrollment that we've talked about, decreased financial aid, student financial aid and scholarships, unexpected expenses and cost overruns, and investment market volatility, that could affect endowments. In the operational risks section, we're going to be looking at potential cybersecurity threats and data breaches, natural disasters or emergency situations, aging infrastructure and deferred maintenance, and anything that could affect the day-to-day business activities, such as computer systems being hacked, sensitive data. Those are the kind of things that might fall into the operational category. And the reputational risk are risks that could damage the institution's good name and credibility. Again, we talked about potentially a professor plagiarizing, or if a school, it affects or doesn't handle a student complaint very well, could impact the institution's reputation, which could have ramifications with, you know, the reputation of the school in the community, in the education hierarchy in general. And then there's strategic risks. And some examples of ones that relate to the higher education world are ones that would challenge or that could prevent the institution from achieving their long-term goals. So let's say you decide to launch, again, a new degree program without properly researching market demand. So you've invested a lot of money in hiring professors and whatever is needed for that. But then if there's not enough students interested, or even if they're interested, they graduate with nothing or no jobs to be seen. So I think the point of these is just to help you compartmentalize how we would identify the risk and notice that it probably covers academics, you know, the maintenance, the financial, it recovers the wide range of the financial or the institution, and not just wanting one group of people that on the leadership team to come up with this. You need inputs from across the institution. So again, reasons to implement a process. It definitely creates structure, and it helps to be proactive so that you're thinking ahead as opposed to reacting to something that occurred. It also helps with informed decision-making. When you have a risk registry, the chances are, like even in the last presentation, the whole time I'm listening to them, I was like, they're speaking my love language, because what they shared was they had identified some of the issues. They knew what needed to be done, and they were prioritizing. Unfortunately, they got punched in the gut before they had a chance to implement everything. So it's important to have a risk registry of items that need to be done. You're not going to be able to hit every single one of them, or in many cases, just because you put on the risk assessment, you may be controlling it perfectly fine, but it's good to have that information in one place so that you can constantly monitor and look at it. Also looking at compliance and regulatory requirements. More times than not, as I think even Kevin referred to, that Title IV requires a risk assessment being done. And so sometimes I think people don't take that opportunity to really deep dive. They may just kind of go through the effort and say, hey, we have this, but it's really important to have it be a living, breathing document, very similar to a strategic plan. It enhances stakeholder confidence. I would hope board members are asking about it, may or may not, but if you're showing them that we're constantly looking at this, and this is why we've chosen these items to be in our budget this year based on this risk assessment, and linking it all together, it just increases the confidence that stakeholders might have. In improving organizational resilience. I remember when I was in my early days and I was working for Kentucky Housing Corporation, and we had a real champion in the area of business continuity and ERM, and she led our effort, and we all kind of went at it sort of slow. But one of the things that she wanted to put on the list was the pandemic. And so back in those days, I was like, what are the chances? I mean, we're not going to have a black, and here we are, you know. I've always wanted to find Donna and say, you were right. You were right. Improving organization. So, and I'll even share that, when I worked for JCPS as their head of audit, the August before 2022, so August 2019, they did a tabletop exercise, and the topic was the pandemic. And I remember talking to the chief of staff after that and saying, who would have thought? She goes, I know. She goes, I picked it because I figured it would be such a far-fetched idea, but it would touch so many things that we were really needing to look at, is why she even picked it. And I asked her, I said, so do you think going through the tabletop exercise helped you prepare? She goes, oh yeah. She goes, there were obviously things that came out of it that they weren't ready for, but she goes, there were a lot of things that they were prepared for because they'd gone through the tabletop. So again, helping with that organizational resilience. And then cost savings and efficiency, because if you're able to budget and prepare for the items as opposed to for instance, during the pandemic, the toilet paper shortage that we all had, because the mass, if you're able to kind of prepare for those things, maybe it won't cost you $100 for a roll of toilet paper. So this is again from the Association of Certified Fraud Examiners. And what I like about this is it kind of breaks down by industry and shows what type of fraud. So of the 70 cases that were reported, that totaled the 50,000, and that was the median loss on that first report, but shows for the 70 cases that fraud came through billing, cash larceny, cash on hand, check and payment tampering, corruption. So it just kind of gives you an idea, like in a more sliced measure of where some of that fraud occurred, so that you know maybe where you need to be honing in on areas within your risk assessment. So again, this is when you're doing the risk assessment, it shouldn't be, I just like to emphasize that it shouldn't be just in a little small area. You need to pull in resources from, many different thought leadership to kind of help you hone in and create a really robust process. And I even think the data analytics that talked about, but I was thinking how some of that information would be really useful as you're going through this risk assessment process. So again, the role of the risk assessment is to help to basically support institutional goals. But it aligns, as long as you're aligning that risk management with the institution's mission, vision, and strategic objectives. Again, looking at those potential obstacles, proactively identifying and addressing those vulnerabilities before they escalate into really big problems. Fostering a culture of risk assessment within the organization is another positive that can occur. And demonstrating to your stakeholders, such as the students and the parents and alumni, that the institution takes risk management seriously and has plans in place should the unforeseen happen and potentially derail some of the goals and objectives. So key components of a risk assessment. So we've kind of been talking through the process, but risk identification is recognizing and documenting potential risks that could affect the organization. Again, we talked about those operational, reputational, strategic, and financial. Analyzing, looking at those risks in detail to understand how they happen. So you would use maybe student complaints, data from the financial aid office, data from your academics office, any kind of data points that you can have to help you from your cybersecurity, your CISOs, just any kind of information that could help educate you on the risk so that you have a good picture. Prioritizing and then evaluating, which is prioritizing those risks, coming up with a way. So I know in the risk assessments that I have done, for simplicity, we'll just say, so for likelihood, we may give a risk high, medium, and low. And then because I'm an accountant, I have to always have things come in numbers. So I would say high, I would give 10 points, medium, 5 points, low, 0 points. And so each one comes out, it would come out with a total score. And then add in velocity in there could be, exponent, like 2 times the number, to kind of help identify and put them in some kind of financial order. You may be able to override that, but for me, it just helps me kind of do a quick look at which things seem to be falling up the highest. I mean, you could just say if it had 2 H's, it's high, and 2 me, you could do that too. But for me, I work in a good analytic way. And then how are you going to treat it? So when you do a risk assessment, you're assessing the risk on what they call inherent. If you had no controls, what is the risk? the truth is most organizations have controls. And so a lot of times it's hard to do that first assessment because you're like, well, of course, well, we have all these checks and balances already in place. And that's good. And you want to document those on, but when you do your first run through, you want to come up with what is the inherent risk? If we had no controls in place, what would happen? And then once you document your control activities on the same document, you give that a weight on how much is that reducing that risk. And then you're left with residual. Once you have your residual risk is when you then use that to kind of help prioritize, because you may have certain risks already controlled and you don't really need to do much more to it. So how you're treating that risk can also have an impact in the end result of the product. And then you want to, again, you don't just button it up, put it on the shelf and check off the box. You need to pull it out annually when you're doing updates on your strategic plan, or as you complete tasks, update it and move other things to the top of the list. So risk appetite is the area that I think causes, and when we were at Kentucky Housing Corporation, it took us a lot of time to get us, or not Kentucky Housing, but Kentucky Higher Education. It took us a lot of time to come up with that risk appetite was, because our marketing people have a very low risk appetite. Accountants, we have a very conservative approach, you know, so it was on two ends of the spectrum and we had to come somewhere in the middle on trying to decide where the appetite needed to fall. And that takes a lot of conversation. And then sometimes it takes I think sometimes depending on the type of leader you have too, I've worked for many visionary leaders and their risk appetite is much lower than, or much greater, no, lower than mine. My appetite is like really big. Their appetite's really low. They're willing to take the risk. Let's try it. So when you think about risk appetite, you want to think about what's your willingness to take risks in the pursuit of your objectives. You know, how much money are you willing to leave on the table should a risk occur? So to kind of bring it down to layman's terms, just say you're planning a road trip. Some people choose, like me, the safest route. Even if it takes longer, I would rather ensure that I get to where I want to go as opposed to having a lot of detours. Where my husband, on the other end, he kind of likes to take in the scenery and see the pretty trees. And I'm like, no, let's take the highway and like, let's get there as opposed, but there could be traffic. And I'm like, yeah, but I'd rather be sure we're on a main road that has access to gas stations and toilets as opposed to a long, windy road that may not. So deciding what your risk appetite is a very important piece of the puzzle. And it also helps you in prioritizing what you're going to spend your money on, your resources, and your time. So some considerations that institutions should take into account when you're looking at risk appetite is the capacity. You know, what is the budget? What is the amount, you know, the maximum amount of risk that can be absorbed by the institution, the tolerance, the variation of performance or outcomes relative to the expected targets, risk profile, the overall landscape, you know, including the types and levels of risk that face across, you know, various areas. And then the culture, what is the shared mindset of the stakeholders at the institution? And by defining this helps, you know, an organization come together and articulate a risk appetite that's communicated to everybody so that everybody buys into that comfort level and understand what it is. Because again, when I was at Kiza, our marketing guy, he would spend money without any idea. Well, it could help us, but there was never, you know, but will it help us? And then he never wanted to evaluate after the fact because, well, we don't need to talk about what we're not making because we can do, you know, it was just a different, keeping him reined in was a challenge at times for me. And it wasn't my job to keep him in check, but I took him on sometimes. So coming back to the best practices. The first step is to identify the right framework that works for you. Engaging stakeholders from across, gathering relevant data, that's an important piece. You don't want to go into the process blind, and then integrating it in not only to your strategic planning and decision-making processes, but your budget, etc. So now we're going to walk through a case study that I found when I was doing research for this, but the University of Washington implemented an ERM in 2006. So they were like really leaders in this, and it's still active today. I looked at it on the website. So we're going to kind of just walk through the steps, and I've just picked one category. This is just one category of their risk assessment, and it was in the operations area. So the category is campus security and safety, active shooter incidents. So they first identified the risk. Well, actually, it was campus security and safety is the category. And then these were the additional incidents within that category: active shooter, sexual assault, theft. You can read. So identifying the risks that link to that campus security. The next is to analyze the risk. So we're just looking at active shooters. So we've gone back here, we looked at campus security and safety. We took one of those risks, active shooter incidents, and now we're going to analyze what is the likelihood, what is the potential impact, what is the velocity, what are our existing controls and mitigating measures, and then what is our vulnerability and exposure to this area. And this is where you would obtain information from your campus security, from research on student events, active shooter events, across your industry. I'm sure Nakubo and Sakubo might have some information that you could go to, but analyzing that risk with data, not just how you feel about it, but actually true data. The next in that one, in active shooter, is evaluate those risks. Prioritize it based on the likelihood, impact, and philosophy. Determine if your current level of risk lines up with the tolerance or the appetite that we talked about. And then what are the benefits, costs and benefits of implementing additional mitigation strategies? So you've looked at what you've done. You look at what are some of the best practices out there, and do we want to bring those best practices into our institution, and what are those costs? And then align those priorities with the institution's mission to provide safe, secure learning. So this is just taking it to the next level. And then mitigating risk. So we've just kind of going back, we've identified the risk, we've analyzed it, we've evaluated it using data, benchmarking it up against our risk tolerance, and now we're going to mitigate. We're going to enhance physical security, whatever that means. We're going to update policies and procedures. We're going to provide training and education. We're going to improve communication, coordination with law enforcement, investing in technology solutions, and allocating resources and budget to mitigate. So these are just some examples, again, with campus security and safety active shooter incidences that you would go through this particular item. So this kind of takes a step back and looks at how we're going to monitor, again, just constantly monitor, measure, audit, gather, adjust, report. Just constantly have it in that cycle to continue to make the ERM even more and more robust. So sometimes it's good to just start off with a small little piece of it and then continue to grow over time so that it doesn't feel overwhelming. And again, this whole process, the whole purpose is to help with informed decision-making so that there is a method to all the madness that goes into deciding how the resources are being spent. And I also think bringing multiple layers of employees involved in the process helps in the buy-in so that they understand sometimes, I think sometimes people sit on the outside of the budget process and don't understand, why are we not prioritizing this? It's because we have 10 other things we've got to prioritize, and getting buy-in to that process can help with creating patience, creating understanding, but then also creating commitment in how can we get this done? So again, hoping that we have a little bit, planted some seeds about the benefits of risk assessments in supporting financial stability, operational efficiency, managing reputational issues, and definitely supporting strategic alignment. These were some top 10 risks, again, during my research for institutions to consider. That, again, will be in the presentation, but I wanted to be sure I was sharing. So these are some like kickoff board that you can use if you want to begin. If you haven't started one, or if you have one, go back and see, do we have these items included on these? Because this came up as a top 10 list for institutions to consider. Where do you start? Identifying that framework, engaging stakeholders, gathering relevant information and data, and then be sure that you're setting up a process to continuously monitor and improve it. It doesn't have to be perfect, but starting somewhere is better than just pushing it, kicking it down the road. And then I've included some research that I use to kind of help, help form this presentation and share some, I hope, information that will help you. And I will now open it up to any questions, or if anybody wants to talk about if you have a risk assessment and how it works for you, and if you kind of follow this framework and positives and negatives. Does anybody have a risk assessment? No?
Oh.
Yeah, because it's been some great exercises that I've done in the organizations that I've worked with, even as a chief audit executive, and then even in my role now, helping organizations kind of begin that process, begin the journey. Again, it's a journey, it's not a destination. It's going to constantly evolve, and it needs to grow with the organization, it needs to not be static, it needs to move. Okay, yeah.
What area do you see being responsible for this process?
Yeah, so it's great having, it needs to start with the president, and then he might delegate it down. And so at Kia, when I was at Kia, internal audit, we helped facilitate the first one. And the idea was just getting it started. But then, thank goodness, we had some individuals that were really interested in taking it on, because again, it's across the organization, but the president or the CEO or whoever needs to say, this is what's going to be done. That's what helped us, is once the CEO said, this is going to be done, then we had people that were willing to take it on. And it's still going on today, which makes me very proud, because I've been gone for a while and it's still happening. So.
We have a virtual question. Is DEI still a top 10 risk, even when colleges are starting to step away from it? For example, UNC Chapel Hill.
That's a good question. So this was research that I've done in the last few months, so it was still showing up on the top of the list, but it very well could be when you begin delving into it and looking at the data points, it may not resonate for you or for your university. So I think those are just suggestions.
Jody, I don't think that it is from a student enrollment perspective.
Yeah.
Although you still have to have a plan around the changes that are happening around the country.
Mm-hmm.
The risk that was on the screen was more driven around
employees.
Hiring.
Mm-hmm. Yeah, good point. Good point. Good deal. Well, thank you all very much. I appreciate your time.
Today, we're going to talk a little bit about unrelated business income. And we do have polling questions. I don't know what the polling questions are yet, so when they pop up, I'll be just as surprised as you are. It'll be the same process that was done earlier today. Again, just a disclaimer. And one of the things that we want to do is kind of cover the basics of what unrelated business income is and the analysis that you go through. Like, we understand how busy you guys are, how much responsibilities you have as CFOs and controllers of colleges and universities. So, and tax is probably this big of all the stuff that you have to do. So we just want to make sure that this part doesn't become this month that you have to do. And the one part you always have when you do a presentation like this is you have to understand how big unrelated business income is. It's huge as to what's out there. So what we'd like to do is talk about the basic principles of unrelated business income, gain an understanding of the decision-making process. This is the process that I've used over the past 30 years to kind of go through and say, what is unrelated business income? What process do I go through and think about what different aspects of unrelated business income, what makes it unrelated, and what could exclude it from unrelated? Recognize what the modifications and exclusions are. There are certain activities, just the way that they're carried out, that will not be unrelated business income. There are certain types of income that will not be unrelated business income, generally. How to identify those, we'll walk through what each one of those are. And then those are the basic part that we'll be dealing with is 1 through 4. We'll review the impact of what the unrelated business income activities are to your charitable purpose, your educational purpose. We'll discuss briefly the deductions of UEI, and then give some applications and examples. Throughout the presentations, I'll try to show examples, and I'll try to put it in I did try to put it in the college and university setting, so you'd be able to see how it would apply to you. This is me. I'm Brian Pouch. I am part of the merger that occurred on January 1st. I am a tax professional. I've done basic work with over 25 years, probably closer to 30 years, of dealing with nonprofit organizations. Prior to coming to Von Lehman, Dean Dorton, I was the partner in charge of a top 30 CPA firm in regard to the nonprofit tax. So this is what I do on a full-time basis. So you can call me on April 14th and I'll be doing nonprofit tax. You can call me on December 31st, I'll be doing nonprofit tax. That's the nice part of the job I have. I can really focus in on nothing more than the nonprofit organizations. Aha, here it is. What is the best pizza topping? This is going to be a tough one. Yes. There we go. Now I got some jalapenos coming here. The one thing I don't like is mushrooms. So that's the one thing. I give them all to my wife. Right. Well, I think that pretty much does it. Pretty much nails it down. It's pepperoni. So one thing you've learned today. So what is unrelated business income? How do I get rid of this top bar? To get rid of this?
You might not be able to because you're sharing your screen, but.
So I just can't see the top part. Okay, sorry.
Yeah.
Okay, what is unrelated business income? Basically, it's income from an activity that is unrelated to the exempt purpose. That's what unrelated business income is. One of the toughest things sometimes, and you always get yourself caught in this, which is, I'm going to use the profits for. And that's what a lot of people will say. I'm going to use the profits for. IRS doesn't care. It's what you're doing with that activity that matters. So what constitutes unrelated business income is the way in which you carry out that activity, not what you're going to use the profits for. And why do they have it? Of course, to eliminate unfair competition between exempt orgs and for-profit entities. The three basic principles, and this will be part of our decision-making process, is the activity must be a trade or business. It must be regularly carried on. That conduct of the activity is not substantially related to the tax-exempt purposes. If any one of these three do not exist, you do not have unrelated business income. Because we're going to be talking about the modifications and the exclusions. Those are all to point that if you already have an unrelated, you have a trade or business, it's regularly carried on and it's not substantially related to your exempt purpose. And that's when we get into modifications and the exclusions. So when you're going on and you're looking at something and all of a sudden you look at it and you say, okay, one of our students, the students invented something and now we're going to sell it. Or this artwork this one student have and we're going to sell it. And you're going to do it one time. One time only. Well, you can stop, right? We'll talk about what regularly carried on means, but that is not regularly carried on. It's not something you're doing every day or has a way in which a for-profit business would act. And when you're talking about unrelated business income, it is always based on the facts and circumstances. It's always more from the situation of what are all the facts surrounding it. Because it's, one of those things you can look at it and say, this is unrelated business income, this is not. And there's a whole bunch of gray in between as to where do you want to go? How much do you want to effectively play in the gray? Do you want to make it more toward, something that's not unrelated and to related? Then you change some of the facts potentially. So basically, when you're talking about unrelated business income, you always look at the documents that are associated with it. Looking at the contracts, looking at the agreements, the memorandum of understanding. So you have a basic facts and understanding as to what's behind this activity and why you're carrying on that activity. Discuss this with your advisors. This is what I always tell our staff people when I'm working with them. Don't rely on email. You have to talk. You have to go ahead and explore because you should be asking questions to each other as to, how are you doing it? Could you do it this way? Maybe you could do it that way. Which I always do like those conversations, when it occurs before the activity actually happens versus afterwards, and you're trying to figure it out and kind of clean it up. But so you have to really research all the facts and circumstances. And if you look at it, this is kind of the process. And the number one is the organization subject to the rules. I mean, you guys all know you are. Basically, if you look at it, all organizations that are exempt under 501A, 401A, which includes any state universities and colleges, you guys are subject to it. Churches, any type of organizations that are part of the church itself are subject to it, along with IRAs, retirement plans, and health savings accounts. All are subject to unrelated business income. Now, these are the ones that we're going to be talking about that I think are important, and that is, is there a trade or business? Is it regularly carried on? Is it substantially related? That's the basic framework that we'll go in a little bit more detail of. What is a trade or business? It's an activity, is not a trade or business. If it's not a trade or business, then it's not unrelated business income. So if you're operating it similar to the hobby loss, I mean, sometimes when you look at what's a trade or business, you look at the hobby loss rules on the for-profit side. And that's not a trade or business. You're just doing it for fun. You're doing it not for profit. You're not trying to make money. Basically, a trade or business requirement is furnishing of goods or performing services for the production of income. And you're competing with other businesses. And generally, the profit motive is the most determinative factor. You're trying to make money. And this right here, when deciding whether or not you have a trade or business, you can take a look at it. You say, the manner in which you are carrying out the activity, the expertise that you have, the time and effort that you're doing it, the expectation that the assets may appreciate in value. So this is something that you're looking at. This is how you would actually run a business. You're actually trying to make money. And then the last sentence, if you take a look at what the definition of a trade or business and unrelated, and when an activity is carried out for profit that constitutes an unrelated business, no part of that trade or business shall be excluded from such classification merely because it does not reach a profit. So if you're trying to make money and you don't, that doesn't mean, oh, we don't have unrelated business income. You still do. Now, today, we are not going to be talking about siloing rules. Those are new, not new these days, but that would take another hour to discuss all the different aspects of it. And then just be careful of the fragmentation rule, which is the IRS can carve out certain components of an activity and treat that fragmented business as a separate trade or business. So if you're looking at it, you're thinking about it, and you're saying, okay, I've got this college bookstore, and it's going to be selling all these goods, whatever, to the kids, the students. It's going to be selling books, and they also sell refrigerators. Well, the IRS is going to say, no, even though 90% of your activity is basically for the convenience and for the students and it's furtherance of your charitable purpose, you're selling a refrigerator, which competes directly with the Best Buy that's 30 minutes away. So they're going to be looking at it and say, we're going to carve that off. So it's that fragmentation part that you always have to be concerned about. University athletic facilities can be used for both related and unrelated events. You can use it for the students. The general population can also use it, and that the general public, which isn't part of your students, it could be unrelated business income. Is that business regularly carried on? We determine now that we know we have a trade or business. Is it regularly carried on? And what does that really mean? The key is the same frequency as a commercial business would operate. If you do it one and done, and that's all you do, then you don't have unrelated business income. However, if like what I have here, the last point here, seasonal activities could be deemed to be regularly carried on. Go to my next slide here. Oh no, I got a polling question. Okay, we'll do the polling question next, and we'll get back to regularly carried on. What do you find to be the scariest? Heights, flying, small spaces, and needles. Let's put this one. Which one do you find to be the most scariest? You might have more than one answer. And the final answer, the final majority rules, and it's heights at 55%. I agree. Basically, again, regular carried on. You know, if it's a short period of time that other commercial businesses would do, then you have a regularly carried on activity. But it has to be in that same type of commercial activities, the same type normally pursued by the for-profit businesses. You know, it's like the best one here, the last example when we talk about horse racing. I'm not from this area. I've been down now in Kentucky for 4 years. And I do know that horse racing is only done periodically during the year, only twice a year. So if you operate something as an exempt org, it would be unrelated business income. Same with the conduct of business activities for one day each week could be considered regularly carried on. If you're operating a commercial parking lot one day a week, be considered unrelated business income. It could be considered regularly carried on. A church employee designs a computer software for a church's use, and then the church usually sells that. Again, it's one and done. The courts found out that, they looked at it and they said they only did it once, so then you're fine. It's not regularly carried on. And then the courts and the IRS have agreed that the gain from frequent and continuous sale of parcels of real estate may trigger unrelated business income. I worked a lot in the Illinois area, and there was a lot of sales of land. And we always had to be careful in regard to how often they were selling it, in what manner, and how they were actually operating that selling of land, making sure it wasn't similar, basically commercial endeavor. Is the activity, I mean, once we now know it's a trade or business, it's regularly carried on, is it now substantially related to your exempt purpose? That's where I think a lot of times when you look at it from a college standpoint, this is where you guys are going to be at. It's determining how it's related to our exempt purpose. Basically, the unrelated trade or business as any trade or business for the conducting not substantially. Basically, it's not something that's in charitable, educational, or other function constituting the exemption. And again, it depends on the facts and circumstances. Because we can kind of go through stuff and we can talk about different activities and we can say that it's not related because you do X, but it is related because you're involving the students and you're helping the students with their education and you're letting them do on the activity. And now all of a sudden, now it's something that's more related to your overall exempt purpose. It's always kind of hard when you look at substantially related. You have to factor in what must be, what type of activities, the extent and size of the business activities. The larger the scale and more extensive, they may be considered unrelated. So if you take something that generally is what you would consider to be related and you multiply and you grow, because, we talked about today that you kind of mentioned about the financial restraints that colleges and universities have. So what's the next thing to do? Where else can I get the revenue? And that's where you have to always remember the tax person, because that's what it is. Remember this process that you're going through and making sure that you can say, yes, this is a trade or business. Yes, it's regularly carried on. Yes, it's substantially related to my exempt purpose. And that's the key when you're kind of going through it and you're looking at new activities and trying to raise more money for the school. In this example here, it was a sale of milk and cream by an exempt entity operating an experimental dairy herd. Educational. You take that milk and you make ice cream. You sell pastries along with that milk. You are now exploiting that exempt purpose. And remember, we kind of talked about that aspect of fragmentation and splitting out the different activities. Well, now you can see what you've done. You've taken something that was related and you're now taking it bigger in order to make more money, which is fine. And I will always tell you guys that unrelated business income is not bad. Just subtract out 21% for federal purposes for now. It's not bad. But you can see what's happening here. Now, all of a sudden, you're generating an activity that's no longer related. The tough part about substantially related is that's always based on the facts and circumstances. It's always based on that. And it's harder to say because there's no really rule. It just must contribute importantly to achieving your exempt purpose. So take a look at what you're doing, how you're doing it, and why is it important to what you do. I did come across something that I thought was interesting when I read this about a college and university. The educational purposes of universities and colleges, teaching, research, and public service have been recognized in the federal law as critical to the well-being of our democratic society. Higher education institutions are in turn exempted from income tax so they can make the most of their revenues. This tax exemption enables universities and colleges to maximize the benefits they provide to society, including an educated citizenry, if I can say that, which is essential to our democracy, a highly educated, skilled, and productive workforce, which is critical to our nation's competitiveness, and new innovations and technologies that improve health enhance our quality of life, strengthen natural security, and fuel economic growth. This is what you guys do. So when you're looking at it and saying what this activity is, how is this activity related to all the good things that you guys do? We don't care about what you're going to do with the money. So the profits, again, just park that off the side. Look at the activity. The IRS ruled that items like this is for a museum, puzzles and posters and books and t-shirts, other items were educational and had a nexus to the educational purpose of the museum's exempt purpose. Items sold contain accompanying descriptive literature. The ruling emphasized that the nexus created between the items sold in the museum gift shop and the accomplishment of the exempt purpose was substantially related. So they can look at your bookstore, take a look at what you have, and what is in there. I can't tell you, we had an IRS audit that came up. This was actually a trade association. And they tried to get the logo-ware at first. They tried to get the logo-ware to be unrelated business income because they said that there wasn't any educational description afterwards. But we actually were able to convince them and say that was more promotional in nature and it was there to generate interest in the organization, and we were fine. He dropped it. Where can UBI hide? Your arena, auditorium, conference centers, parking lots, advertising, golf courses, travel tours. I heard people during lunch talk about all the different graduations that are at the arena. Yeah, it's a public service. It's good that you're providing that avenue for colleges, for high schools that can have their kids there and graduate. Perfect. It's related. It's what you guys do. You guys are providing a public service. You're providing that information to these charitable or other charitable organizations or educational institutions. Conference centers, well, all of a sudden now you're renting to Dean Dorton, and Dean Dorton is basically running their annual meetings or different meetings there. Can that be considered to be unrelated business income? Yeah, could be, depending upon how it's all set up, but more likely, yes, probably. You do it to another charitable organization, another 501c3, because I've had colleges break it up between the C3 organizations are over here and they're fine, and then the for-profit entities are more of an issue. You look at catering and food services. You look at it, and we're going to be talking about one of the aspects, which is for the convenience of the students, your members or your patrons. That's one of the exceptions that we'll go through a little bit later. But all of a sudden now you start catering and you're taking that same food and now you're selling it to the general public. That would be unrelated business income. You're now doing something more outside of your exempt purpose, and you're effectively exploiting that aspect. Oh, coffee shops is a good one. If you look at it, a coffee shop that you might have for the students, it's inside the school building, right? It's inside one of the halls. Who's going to be there? Students. So again, convenience for your students. And we'll talk a little bit more about this. But what happens if you have a coffee shop that has an outside entrance that says Starbucks, and now you're advertising and you're going in a local newspaper? That's an issue. You took something that was potentially, because it's just for the students, and now you're exploiting it, and it could be unrelated. Now that we know that it is a trade or business, we know that it's regularly carried on. Oh, I should say, yeah, that it's regularly carried on, and it's not substantially related to your exempt purpose. Now the next step is the activity exempt from tax? Is it exempt because of how the activity is being carried on? Just for how you do it could go ahead and exclude the revenue as unrelated business income. And one thing here to note a little bit too is just to make sure, if you're a college or you're a foundation and you own a partnership interest, and you are getting that income from that partnership is carrying on a trader business. Flows all the way to you. So generally, you will see on a partnership return that it could be unrelated business income because of the activity that they carry on. If we get that, I know we're halfway through, so I probably won't get to the end, but there's an issue. I've got some slides about partnerships and unrelated business income. So let's talk about common examples. Again, you have a trader business. It's regularly carried on and it's not substantially related to your exempt purpose. These are the ones that the type of activities that will no longer be unrelated business income just because of how it's being carried on. A volunteer labor, where 85% or more of the workforce is basically volunteers. We'll talk a little bit about that. The big one for you guys is member and patron, basically for the convenience of the students. That's where you've got your housing, you've got your food. It's all for the convenience of the students. So that's how that works. So we'll talk about the word primarily for the convenience of the patrons. We'll talk about that. Donated items isn't much of a deal. Game of chance. That's not really something that you guys probably do. Qualified sponsorships probably is. You guys probably do have some fundraising events. If you've got a foundation or something in that regard, and they're putting on a gala and you're asking for sponsorships, that could potentially be it's something that it's potentially excluded from unrelated business income. It also could hide some unrelated business income as well. And just so you know, sometimes how big this is, I spent an hour talking to a bunch of trade associations about sponsorships and how sponsorships work and that what parts could be unrelated or not. So when I talk about all the stuff that's out there, there's a lot of stuff out there. So what we're trying to do is trying to shrink it down to say, this is the format that you use. And then from there, you can drill down a little bit more and find out, well, okay, what do I need to know, Brian, about qualified sponsorships? And then the next three probably doesn't apply to you guys as well. Volunteer labor, just remember volunteers mean volunteers. That means they're not being compensated. 85% or more of the hours will have to be done by volunteers. Generally, you would see a lot of it where the people are doing the work are volunteers and they might be having somebody overseeing everything that's being paid. As long as you look at the hours and looking at it, the 85%, you're fine. You know, the volunteer hours, though, have to be hours in which that are actually generating the income. A lot of times you'll see that like for raffle tickets, split the pot aspects when you're looking at something like that, where people are going around, they're volunteers, and they're the ones that are out there selling the raffle tickets and that kind of stuff. So that's where the volunteer of labor actually comes in. Again, some of the ones, these are just ones that they have out there, the production and sale of records. This is what actually in the regs. So they still have the sale of records in the regs that by volunteers qualify for this exception. Trade association basically can exclude their, or anybody can exclude their advertising revenue. Advertising generally per se is unrelated business income because it's not really related to your purpose. Advertising a for-profit business. But if it's being done by volunteers, you're fine. Your school newspaper, I don't know what they have there, but the school newspaper is not necessarily generating ads. And they're all volunteers that are basically operating the school newspaper. That potentially could be excluded from unrelated business income. The same with conducting catering services and tending bar. Another one potential for volunteers. Just be careful. People that work 8 to 5 and then volunteer at night, more likely a requirement for their job and they're getting paid for it. This is now when you talk about the exception for the convenience exception, convenience of your students or the patrons. It needs to be primarily for the convenience of its members, students, patients, officers, or employees. Goods or services provided and sold by colleges, including something that's on recurrent demand and not useful more than a year. That's generally what's in your bookstore. Is not going to be unrelated business income. That's going to be the convenience of the students. Dormitory rentals during the school year, again, that would be something that's more, again, for the convenience of the students. If you look at the definition of primarily, what they're going to do is they're going to look at it. If there's something that's kind of like on the border, they're going to look at who's using it. How many students are actually patronizing that coffee shop versus number of outside people doing it. So they're going to be looking at and saying, where is the revenue coming from? Is it coming from students and their, meal plans, or is it coming from others outside? So that's what you talk about primarily for the convenience. And I was trying to tell people that's sort of similar to this fragmentation aspect. You just cut it in half and say, well, that's for the convenience of your patrons. This is not. So that's going to be subject to unrelated business income. And again, this is one of the exceptions. The activity would be unless another exclusion or exemption applies. Use of university fitness center by employees, that's fine. Convenience of the people, the employees are there. Parking lots for students, employees, or visitors, that's fine. There's a business next door, or close, and they're trying to rent space from you, and they're taking some of the parking. It'd be a problem. There could be unrelated business income. Sometimes what we do on that is that if you look at it, you say, if you're operating the parking lot and you're carrying on the parking lot and you're renting it, well, what happens if you go ahead and you hire somebody and you contract it out and they're renting it? Now you're renting real property to a person who then is renting out the parking lot. That's how you can get around it depending upon your fact situation. Laboratory analysis and testing of the patient's specimen would qualify for this exception. Not that you guys have it, but you might have a educational institution associated with a university. If all of a sudden you're doing the testing of some other hospital or some other healthcare entity, well, they're no longer patients of your hospital. They're the different hospital. State University operates a bookstore and supply store, a cafeteria and a restaurant on campus for its student body and faculty qualifies for this exception. I did work for one of the universities that actually had their own restaurant. And that was unrelated business income. It was in a separate entity and they ran it as a for-profit business. There can be, situations where you're looking at it and your students and you're running a program for food service, in that type of degree, that could help you qualify to say that it would be related because it's learning, because you're carrying it on in such a way for the students to learn. So if you have, faculty there or people reviewing their work and everything else, that's something that's in furtherance. You can see how now you're changing the facts, that you're just not operating a restaurant. It's really for the education of your students and they're going through that same process. So that's why, even when we talked about earlier, it is so factually determinative as to whether or not something is related or unrelated. And that's why you really need to talk and analyze the situation that you have. Selling merchandise substantial is all received as gifts or that's something different. That's basically the donated items. We don't have to worry about that. You're not Goodwill. So you guys, you don't have to worry about that. Bingo, I won't talk much about bingo. Sponsorship payments. Okay. There's a specific code section on sponsorship payments. Sponsorship payments will not be unrelated business income. Right? Basically, a sponsorship payment is any payment of money or transfer of property of services engaged in a trade or business where no arrangement or expectation that business, the person who's paying the sponsorship, will receive any substantial return benefit other than the use of the acknowledgement or name. And substantial is 2% of the amount. So if you receive a sponsorship that somebody pays $100,000 and now you're looking at 2% of 100,000, you're looking at $2,000. Do they receive benefits of more than $2,000? If they do, they don't fall under qualified sponsorship rules. That does not make it unrelated business income. That just does not allow it to meet this exclusion for sponsorship payments. The next step you do is now as you look at each one of the benefits, the sponsorship, the whatever sponsor-e is receiving, and you take a look at each one of them to see if that amount is unrelated. Say they go ahead and they get a table at the fundraising event. The table for fundraising is not unrelated, so basically all they're doing is buying the table for fundraising event. That's fine. All of a sudden the use of an acknowledgement isn't a substantial return benefit. And this is where it comes into play. And this is why it takes an hour to talk about qualified sponsorships. Because what's the difference between sometimes a logo and advertising? Dean Dorton, the best CPA firm in the country. And we have Dean Dorton. That's not a logo. That's advertising, right? It's qualitative language. It's a call of action. You're asking somebody, read this and do that. So that's advertising. That's not going to fall under something that's in the use of a logo or acknowledgement. Then you're going to look at that and you're going to look at the advertising, and that's going to be more than likely unrelated business income. Okay. Again, use of the acknowledgement does not cause any problems. That's fine. I remember one university that I did work for. We were walking around taking a tour. You go to the baseball field, and on the baseball field on the walls are all these corporations that have sponsors, right? They have paid money, and you look and you read them, and you just ask them, can we change that a little bit? Could you just put their name, their address, maybe what they do, and not have this kind of advertising language associated with it? And usually the people who are doing the sponsor, they don't care. What ends up happening is I always love the situation. You look at you got marketing people and you got accountants. Boy, are we different. There is no question. So marketing people are going to, all they want to do is sell, market. And we're over here saying, you can't do that. You can't do that. You can't do that. So that's where it is. And a lot of times people really don't care. They don't care if all of a sudden if you change something. All right, I'm going to breeze through some of this. Okay, now let's go through the type of income that is exempt from tax. So we talked about it's a trade or business. It is regularly carried on. It is not substantially related to your exempt purpose. The activity doesn't meet any of those exceptions that we talked about. So is the income itself exempt? The most common ones that are exempt, dividends and interest. Generally, those are tax exempt, and they're not going to be part of unrelated business income. We'll talk about when it is. Royalty income generally is not unrelated business income. Rental generally is not unrelated business income. Gain or loss from the disposition of assets are not unrelated. Debt finance property. This is where it gets to be a little more complicated. This is where something, because if you look at dividends, royalty, and rental, generally that's all passive, right? There's nothing that you're doing. You're just basically collecting dividends and interest. But when you start going ahead and you're going to acquire debt, say you're going to go ahead and buy that stock, that's really buy the stock. I have a situation where a university had a part sale, part gift. And to go ahead and purchase the stock of a closely held business, they assumed debt. They took on debt. Well, that's now going to be debt finance. That dividend would have been exempt. Would not have been subject to the tax. But as soon as you acquire debt, they have it. It'll be now taxable. The same with rental. Now, universities are different. There's this acquisition indebtedness rule for universities that basically universities are exempt from. So you guys don't have that issue in acquisition indebtedness on real estate, right? Just on rental, on real estate, not personal property or anything else. But for that, we'll get to that part. And that's what the debt finance rules basically convert stuff into unrelated business income. And then unfortunately, there's exceptions to the exceptions, so. Okay, I'm gonna kind of breeze through some of these things so we get through everything. Royalty income generally is exempt, and it's not gonna be something that's gonna be taxed. However, if all of a sudden, like a royalty aspect, and you're giving your logo and you're letting them use your name, that's fine. Not gonna be taxable. If you get involved in any type of services, like trying to market that product and actually carry on activities to help push that product, you are now taking something that was generally passive, and now you're carrying on a trader business, and it's gonna be unrelated. And if you ever get in that situation, one of the things to do is, talk to your attorneys. We can't draft documents themselves, but I've had situations where what we do is we take the royalty, we have the logo here, we have the marketing services over here in a separate agreement. All the money getting paid from the separate agreement is going to be UBI, because now you're marketing that product. The amount that you're getting from the royalty is going to stay exempt. You're not going to have that issue. So that is something that, again, you just have to make sure you draft everything. Make sure you have a good attorney drafting that. Rental property, this is what I wanted to get to. Rents are generally excluded. And again, you're going to find a lot of different aspects when you look at rent as to when rent can be unrelated. Generally, it's not related. Rents will not be excluded. Again, I always like that. Will be excluded from unrelated business taxable income, provided certain restrictions are met. Rents will not be excluded if the determination of the rent in whole or part on the income or profits derived by any profits, any person from the leased property. So if you're getting involved in based on net profits, you're effectively in the business. You are working with that landlord or that lessee in their business because you're getting paid your rent based upon their income. So you're in that business. That's going to be excluded. Not going to be excluded. A percentage of sales or gross receipts are permitted. So you have that aspect, right? Based on profits. You're also not going to have rent and rental income if it's excluded because you're rendering substantial services. So basically, if you're renting services that are customarily provided by, that landlord in that business, at a church, which actually owned a skyscraper down in Chicago, and they rented each one of the units out, the building out. It wasn't unrelated business income until they acquired debt to improve the property. Now, all of a sudden it was. You guys in colleges said there's an exception for that, right? So basically you have those aspects, substantial services. All of a sudden, if you're renting your space for a wedding, and it's not really related, and now you're providing catering and providing alcohol, now you're providing additional services. Now permitted, these are the aspects providing food service, linen, others. There's a bunch of stuff that goes into this, so I'll go over. Personal property, if you're renting an auditorium and you're also leasing personal property. Think about this again. We talked about rent is generally excluded. Rent will be unrelated business income if you're doing it based on the profits of a lessee. It's going to be unrelated business income if you're carrying out services that are not substantially related or substantially carried on by that type of rental. And now all of a sudden, if personal property is involved. If you're renting both real and personal property, it's going to be looked at, and you're going to have to look at what you're renting. If you're renting lease, if you're renting a lot of personal property, that personal property will paint the whole thing, and it will be unrelated business income. And first of all, if it's personal property is 10%, the total amount is okay. If it's between 10 and 50%, then the percentage of that will be subject to unrelated business income. And if it's greater than 50%, the total amount will be subject to unrelated business income. So basically, you're looking at your rent aspect, you're looking at those aspects. Profits, services, personal property is included. Debt finance comes into play, which you guys generally don't have, so we'll just leave that parked outside. And The other thing that comes into play, which I do have on one college, basically, if you are renting to a controlled subsidiary, if you have a taxable subsidiary, your college and you have a subsidiary and you got a corporation, and they're paying you rent. You just look at it from a conceptual standpoint. They are paying rent to an exempt organization. They are getting tax deduction, right? And if we don't say it's unrelated business income, the exempt organization doesn't pay any tax. That's not right. The IRS doesn't like that. So if it's a controlled entity and you own 85% or more, they're going to go ahead and say that that's unrelated business income. So those are the ones. Again, for universities acquiring or approve real property, that's not going to be debt financed at all. I am getting awfully close to time. So just, I hope that helps in regard to the whole goal here was to try to say, here's your basic framework to take a look at, and say that, hey, this thing of unrelated business income, it's not that bad. You just kind of break it down into parts, look at what you're looking at, and then kind of drill down from there. Yep.
So is the debt finance property, is that just when you use tax exempt debt?
No. Not to be any doesn't have to be tax
So if
exempt.
you have a student center that was financed with debt, you have earmarked in.
No, that's fine. You see, again, really, if you're a college and university, you are basically not subject to the debt finance rules of real property.
Okay.
Okay, so that's what it comes down to. And if you're involved in a partnership and you all of a sudden are flowing that income, if you've got rental through the partnership, take a look at it and write this down. If you're a qualified organization, that UBI number will be different if you're not a qualified organization. Because a qualified organization, schools and universities, I am now told I have to wrap up, and I apologize. I talk too much. I mean, I forgot. See, I even forgot this one, but we'll skip that one. I want to make sure that we have my name and my phone number. My cell phone number, I always talk to people. I have no problem talking to people. My cell phone number is 414-559-6103. Happy to talk to you guys. I'll tell you what I know. That's why I did. Just tell them to say that you're in this conference, and I'll be happy to talk to you. Okay.